Welcome. This is Yahoo Finance Live. I'm Julie Hyman. That's Brad Smith. And we are just waiting for the consumer price index numbers. It's closely watched inflation figures, which are going to let us know what the pace of inflation looks like right now. It is expected that on the core basis it moderated, and indeed it did, coming in at a 0.2% increase on both the headline and the core. So let me just run through these numbers real quick. So CPI rising month over month, 0.2%. That is double what was estimated. However, that was double the prior month, but better than estimated. Core numbers, excluding food and energy, also coming in with a gain of 0.2% here. That is better than estimated. In other words, we are seeing a more moderate pace of inflation on both the headline and the core than had been estimated on a month-over-month basis. Year over year, seeing headline inflation rise 3.0% and seeing core inflation, excluding food and energy, up by 4.8%. So overall, this showing some welcome news for consumers here in the United States, that we are seeing this pace moderate a little bit. Yeah,
and a couple of the themes that are going to continue to come up in discussions today here, context around this. The index for shelter, that has remained sticky here, to say the least. The index for shelter, largest contributor to the monthly all items increase, that accounted for over 70% of that increase. And then the index for motor vehicle insurance also contributing. You mentioned food index as well. That increased about 0.1% in June after increasing 0.2% versus the previous month. So some moderation there in a good way there. And then the energy index too, something that a lot of consumers out there paying close attention to here this summer. That rose 0.6% in June as the major energy component indexes were mixed here as well, Julie. So
yeah, another big area of focus was on used cars and trucks, seeing a decline there of 0.5% month over month. New vehicles flat, no change there. But we're going to dig much more into the vehicle picture a little bit later on. I'm just scanning through some of the other numbers here, seeing a big decline in gas service, utility service, that is, not gasoline, but rather natural gas, down by 1.7%. So that's one of the areas where we're seeing improvement, and fuel oil down 0.4%, although in the summer months you're not seeing as much of a use for fuel oil. But gasoline prices, as you pointed out, are seeing a gain. 1.0% was the gain there. And I'm just looking to see if there are any other areas where we're seeing big increases. Not really seeing a lot of other large increases here on a month-over-month basis.
Yeah, just lastly, before we get some of our guests involved in this conversation too, taking a look at the futures here this morning, as we are still just a little over an hour out from the start of trade here on the day. We're taking a look at the futures. We've got them here on your screen for you. We're higher across the board as of right now. Fractional gains for the Dow and the S&P 500 up by about 0.5%, a little more than that. For the Dow, the S&P 500 still up by about 0.75%. We'll round that up to. And the Nasdaq futures up by about 0.9% right now.
Yeah, the read through perhaps being that while the Fed's next interest rate increase at the end of the month is pretty much a foregone conclusion on the part of most investors, what happens beyond that could indeed be affected by this number and some of the other inflation numbers that will be coming. So that's something that we will be closely watching. Let's talk more about these numbers, how they're affecting the market. I want to bring in Jens Nordvig, Exante Data founder and CEO, and Jordan Jackson, JP Morgan Asset Management global market strategist. Guys, good to see you. Thanks so much for being here. Appreciate it.
Yeah, like this is kind of a hectic time to do an interview right with the numbers coming
out. Yeah, it's fun, right?
This is a huge number, I think. Like, we've not had a number less than 0.3 on the core in 2 years, right? And actually, if you look at the unrounded numbers, this is actually pretty close to 0.1 if you look at the unrounded numbers. So this is a pretty big deal, right? If the Fed in the coming month can see that service price inflation is actually starting to get closer to target, the narrative, I think, can change dramatically. We're seeing pretty big moves in the market, right? The yield curve had already moved kind of a little bit in anticipation of this number, and now we're down another kind of 10 basis points around the whole yield curve. So I think this is a pretty important number, and I think that the market will be digesting it for a little bit.
Yeah, Jordan, how did this kind of pair against some of your expectations coming into the report?
Sure, I'd strongly agree. I think this is a welcome print from the Fed. Maybe they're not fist bumping just yet, and all clear on inflation, but it's certainly a good sign. I had anticipated that the core number was going to be a little bit hotter than anticipated, and specifically, the Fed's been harping on this core services ex-shelter inflation. And what's been interesting, the last several readings, a big chunk of that was transportation services, and then specifically leased cars and trucks. Motor vehicle insurance, as well as auto body maintenance. Certainly lease payments are kind of impacted by the Fed. The Fed keeps raising rates. That's kind of shooting themselves in the foot a little bit there. But elsewhere, it was encouraging to see sort of used car comes down. That should have an impact on insurance payments. And then actually the challenge with the auto body scenario is labor. It's a labor challenge. It's hard to find a mechanic. It seems like it takes 6 weeks to get your back bumper fixed. So that could remain a little bit sticky, but again, still in aggregate, on balance, welcome numbers in terms of the trajectory for inflation for the Fed.
It seems like you're speaking from unwelcome experience there when you talk about it taking a long time to get your bumper fixed. Anything else that stands out to you, Jens, in the components and where we are seeing things abate and things still be sticky?
So when I look at the CPI release, I like to look at literally all the components and see the whole distribution of what's going on, and then look at, okay, what's the middle of this distribution? We've now had 3 months where the middle of all goods has less than 2% inflation. 3 months now. So in the last couple of months, it was because of goods, right? Like we know that there's a bunch of goods prices that are falling, right? But overall, the whole basket together, we have 3 months where the middle of the basket is less than 2%. So clearly things are changing, right? Is it enough for the Fed? We can have that debate. But we're entering a new regime where this incredibly elevated inflation, well above target, is potentially behind us. So that's, I think, is a pretty big deal.
Yeah, and that's what a lot of consumers are wondering too. Is the worst of inflation behind us? The Fed's not going to be fist bumping quite yet, but at the same time, does it change the tenor of the conversation that they're having, Jordan?
Well, I think it does. I think what it allows them to do is maybe get one more hike, and at the end of the month, they're kind of embracing this skip hike pace, so that I think they intended to already skip in September, potentially come back and hike again in November. I think we continue to see this type of progress in inflation. I think we can kind of put that November hike to bed, and the Fed can finally stay on pause potentially through the end of the year. I guess my concern is the Fed's obsession with 2%. I don't think 3% inflation is all that bad, and certainly not a number in which policymakers need to overreact to. But I do think the challenge is maybe going from 3 to 2, particularly when we start to get a 3 handle on the core number. Getting down to 2 might be a little bit harder, and I think that's the risk where the Fed might overreact and maybe want to pencil another rate hike in November, especially if labor markets are still pretty tight.
Absolutely.
Yeah, I think when I look at what's going on in the economy, right, so we had an incredible amount of focus on used car prices, and obviously we don't want to have like the CPI release just being about what used cars are costing, but there's actually kind of an economic meaning to what's going on with these used cars, right? It is because it is so much more expensive to finance any kind of car purchases, right, that demand is changing. And to be honest, like the surprise we've had this year is that the much high interest rates have not been creating like a dramatic credit crunch, right? So I think the next couple of months, the degree to which these high interest rates are going to really feed into certain parts of the economy that are interest sensitive is key. And I think we got one very important data point this week before the CPI, and that was that the consumer credit is now slowing dramatically. We had last year kind of a consumer credit boom because there was no need to borrow because of all the transfers in the COVID period, but there was borrowing last year, and that's now slowing. The higher rates are starting to bite, right? So I think if we have a combination where the headline inflation pressure is coming down, the core inflation pressure is coming down, and in addition to that, we can start to see that actually the consumer is feeling squeezed, cannot obtain the credit that they obtained last year, then the savings rate will actually go up, consumption will go down, and that combination, I think, is what's going to move the Fed.
I think that's a really interesting point because for a long time we were worried about the supply side driven inflation, right? And the fact that Fed hikes weren't going to be impacting the supply side. Now we're seeing hikes finally impacting the demand side on the consumer, and that could very well be is what monetary policy is for. What these higher rates are finally doing, and that should bring that inflation number continuing to trend lower.
What does this report do, if anything, to your strategy, right? Does it, I mean, not just this number, but if we continue to see inflation maybe moderate more quickly than expected, does that change your thinking at all?
Interestingly, I think it's bullish for stocks and it's bullish for bonds. I think it's bullish for bonds, so certainly long-term rates can come down a little bit on the back of lower inflation. And I think it eases off some of the pressures on overall consumers in terms of purchasing power. And so that potentially kind of softens the earnings blow in maybe the back half of the year if we get slower growth, modest recession potentially playing out. So I actually think this is pretty bullish across the board.
Yeah, what about you, Jens? I mean, does a report like this still signal Q3 2023 recession?
I'm not sure the CPI being lower is what's going to trigger the recession, right? Like in a way that means that the Fed can kind of stop hiking a little bit earlier, right? But obviously reflects something that's going on in the economy that might mean that we already had softness. In terms of strategy, right? I think it's very important for the dollar. Like I did a note last night. Maybe if I look a little bit tired now, it's because I was working on that last night. But I think for the dollar outlook, this is really important. We've already seen the dollar sort of started to surprise a lot of people over the last couple of weeks, being weaker than they thought. And the only reason the dollar was really holding up had to do with the Fed being super tight, right? So if that is now in question, two-year rates have rallied like almost 15 basis points on this number, right? So we're talking about pretty big moves, and this is really creating a problem for the dollar. So I think how you want to trade international assets and the dollar is heavily influenced by this.
All right, guys, before we let you go, Jordan, any last, we'll give you the last word here as we sort of like let this sink in, the CPI report coming in a little bit more moderate than expected.
Yeah, I think the Fed should take this as an opportunity to maybe dial back some of the hawkish rhetoric. Obviously, you've seen now financial conditions more broadly are relatively at average over the long run average, and not necessarily tight. They're not necessarily restrictive. But I think if they can adopt a less hawkish tone, we could actually still be in that soft landing camp. I mean, obviously, businesses are maybe pulling back on business investment and capex, so that's going to weigh on growth. You now have a limit, a cap on non-discretionary spending, and so fiscal spending is going to be neutral to modestly a drag on GDP. Also, once we get student loan payments ramping back up, that's going to be a slight drag as well. It's really going to be the consumer that can potentially keep things afloat here and engineer that kind of softish or very modest, shallow type of recession. And so I think the Fed's, again, got to adopt their bedside manner and be a little bit more patient here and not overreact.
All right. Excellent stuff. We're going to have much more to discuss on this throughout the rest of the day here on Yahoo Finance. Stick around. We've got much more starting at 9 a.m.
Well, over the past few months, there's been a surge of companies partnering with Tesla to gain access to the largest charging network in the United States. Mercedes-Benz marks the latest automaker to have done so. It's clear to see that electric vehicles are not just here to stay, but are thriving as consumers lean towards EVs, whether to be part of the growing trend or from climate-associated reasons. Now, Flash is focused on accelerating the growth of smart cities across the United States by offering cloud-based software to assist with parking management and access to electric vehicle charging stations. Let's bring in Flash VP of Utility Marketing Development, Matt McCaffrey, to discuss more about the growing interest in the EV space and, of course, the development of charging stations. Good to have you here. So we do have a lot of sort of differing standards as to how soon we're going to be ready for to meet the sort of demand we have for EVs versus the infrastructure that's currently available. How would you characterize where we are now in the charging space?
Thanks for having me on, Rochelle. So I think that I can speak for a lot of people in the industry that we have been expecting that there's going to be one standard for charging plugs. And what we're seeing now is that Tesla is winning that battle with their North American charging standard plug. So we see this as a good thing. This creates more consumer confidence across the board. So if someone is making that decision to buy an EV, they're not thinking about one charging network that's going to work with their vehicle and one charging network that isn't. So the sooner that we get to that single charging standard, the better it is for consumers, the better it is for the energy landscape, and the better it is for companies that are moving forward in this space like Flash.
And so then in terms of accessibility, how far are we away from the needs people have? Because, some people can charge from home, but and looking at the data on your website, 72% of drivers will need a place to charge away from home. So how close are we to that?
Well, we have a lot of work to do. So there are about 11,000 level 2 or AC charging stations across the US. That may sound like a lot, but when you compare that to 130,000 filling stations for gasoline, we have a long way to go. So about a third of Americans live in multifamily housing, and even more Americans don't have access to off-street parking. So that takes away that convenience charging, the convenience of having an EV, of being able to charge at night, being able to charge when the car is sitting idle. And it's important to remember that light-duty vehicles spend about 95% of their useful lives idle. So we need to bring the charging infrastructure to where the cars are versus this destination fueling model that we've all grown up with, right? You drive a car until it's almost empty, then you drive it to the fuel source, and then you continue that cycle until you're done driving that car. EV charging is different. The charging infrastructure is the piece that's needed. The fueling infrastructure is not. We have the fueling infrastructure for electric vehicles under our feet, over our heads, just about everywhere we go every day. And so we need to make a serious effort as an industry and across the country to provide that level 2 charging where people work, where people live, where people go to events, and where they recreate. And that's what that's really our goal as a company at Flash.
And I know we talk a lot about the demand, but the demand doesn't seem to be equally spread, especially when you look across the United States. So talk about the difference between what we're seeing with urban drivers versus in the suburbs and rural, and what that means in terms of how we should be viewing demand for EVs.
Yeah, so we're really focused on the urban environment because as you just were showing on the screen there, we're in over 11,000 sites across the U.S. We're in every major urban center in the U.S. And we're focused on those urban users where the density is the highest, and also where congestion from a utility distribution network perspective is also the highest. So that's why we focus on level 2 charging. Now, in terms of different customer segments and who's adopting EVs and how we're going to get to wider adoption, we really need all the solutions to create that consumer confidence. So we do need that roadside DC fast charging, that destination charging infrastructure in place, which through the Infrastructure Act and through the bipartisan infrastructure law, I should say, we're making that investment at the national level. But we also need to have that relative ubiquity of level 2 charging, where people are parking and where they're shopping, where their cars are sitting idle, like I was saying before, to convince consumers that this is a choice that makes sense for all of them.
So for investors, operators, and consumers who are looking at this, I know you talk about the 3 stages of vehicle to grid technology. What does that mean? What should they be focusing on then in terms of the next evolution of where we are now when it comes to EV charging?
Well, vehicle to grid technology is really enticing, and the industry's been talking about this for years. The ability to use the battery charge in these mobile sources to flow back into the grid and to balance out other demand on the grid is where we are going in the future, but it's going to take a few years to get there. If you think about what is required for vehicle to grid, you need coordination with the vehicle manufacturers, with the charging stations, with the software that runs on both of them, with the utilities and their distribution networks, and where applicable, the wholesale power markets. And then you have to do that in a way that makes sense to customers. That's a really complicated dance with a lot of partners. We are going to get there, but it's probably not going to be in 2024 or 2025, probably by the end of the decade. Now, what we have right now is the ability to use the vehicles through the telematics and through managed network charging to deploy load management and have load management solutions at the grid edge to start using these vehicles and these different mobile sources of energy and mobile demand points of energy to manage the grid. And there are mechanisms out there right now where these can be monetized, where these can participate in wholesale markets, where these can participate within utility programs. And I think for investors, that should be the near-term focus over the next several quarters. Which companies are focused on that technology and bringing those solutions in a monetizable way to market?
I do appreciate you joining us with your insights. Flash VP of Utility Marketing Development, Matt McCaffrey, thank you so much. users are flocking to new apps like Meta's Threads, but can advertisers get on board as well? Let's bring in Matt Voda, Optimind CEO, to discuss. So Matt, good to see you here. So how can advertisers prepare to use Twitter's new rival app in Threads?
Well, I think that they want to evaluate what types of formats and engagement are possible in this new platform, and that's still an open question because brands are not able to advertise on Threads quite yet. The other question, and certainly a question that Optimind gets from the brands we serve, is, should we be thinking about moving budget from Twitter to Threads eventually as these opportunities open up? And so we'll evaluate that with the brands and just look at the ROI potential once it's open for business.
And as we know, obviously, they're waiting for Threads to reach a certain user level before they start opening that up. It could be, 1 million users. I guess we're still waiting to see what that threshold will be. Is there anything that some of these advertisers are really considering when they're looking at some of these other apps? Is Twitter just not where they want to be anymore? And versus TikTok or any other places, what would make them pick Threads versus, say, one of the other competitors?
Yeah, what we've seen historically in some of the analytics work that we've done, in particular with Twitter, is that a brand in its paid and promoted activity can actually increase positive brand sentiment and decrease negative sentiment. And that kind of targeting and in-the-moment activity and investment can move the needle. And I think that brands will evaluate those types of levers within Threads. Can they be part of a conversation? Can they create conversations? Can they be in the moment and more instant with these types of investments? And they're going to evaluate that kind of brand building capability in that decision.
And I just was talking about cannibalization, talking about Instagram. If you're someone who's like, how can I present myself differently as an advertiser on Threads versus I would on Instagram? How do advertisers go about doing that?
Well, it's about content, it's about the message, it's about precise targeting and personalization. And the most sophisticated brands are investing both in terms of people, talent, and technology to deliver this type of content more precisely, whether that's through highly targeted ads aimed at specific kind of messages or interests, or even more precise content and messaging to certain groups of consumers that may have an interest in their product. So the savviest brands, and in particular the brands that we work with, are investing really intelligently with these skills and technology sets.
And for people who don't know, obviously you have to go through Instagram to get to Threads. Does that give a different dynamic versus, say, just going to a standalone platform or a standalone app?
Yeah, I think that's a great question, and the story's still yet to be written. And this is certainly something that brands will take a look at: is, does this represent a truly new group of users that the brand can reach? Or is it more of an overlap with an existing audience that they're already reaching through Instagram? And I think that's kind of the potential risk with Threads is that they're just leaking the same users away from Instagram and not attracting net new users that a brand might be interested in reaching. But it's an open question. It's to be seen. But that's certainly part of the evaluation a brand will look at is, if I'm reaching a truly incremental group of consumers in Twitter, and if I walk away from that and I'm already reaching the same set of users in Instagram, if I'm using Threads, then I might be inclined to continue to invest in Twitter because it represents a unique audience that I may not be able to reach elsewhere.
Yeah, that's an interesting point. We'll definitely be taking a look at that when they do reach that threshold, when they open the door to advertisers. Matt Voda, thank you so much for joining me this morning. Optimind CEO, thanks so much.
Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith, and here are three things you need to know this morning. First up, for sure, inflation is cooling. Whew. June CPI report showing price pressure moderating broadly. The annual headline rate slowing to 3% from last month's 4% reading, and that sticky core number also slowing to 4.8%, which is a bigger slowdown than forecast and a key data point for the Federal Reserve. The reading could mark a turning point for policymakers, especially after recent Fed minutes showed an FOMC perhaps more divided than expected. The central bank still widely seen raising rates again at the end of the month, but what happens after that is in question. It's a good day for Fed speak, and there is lots of it. Richmond Fed President Tom Barkin, Minneapolis' Neil Kashkari, Atlanta's Raphael Bostic, and Cleveland's Loretta Mester. All of them are talking at separate events throughout the day. Bostic has advocated for a wait-and-see approach on the next move. Mester's tone has been notably more hawkish in recent weeks. She's repeated that more hikes are needed to bring inflation back down to the 2% target. And if all that wasn't enough, 2 p.m. Eastern sees the release of the Fed's Beige Book, a key survey of economic conditions. And there are lots of tech moves to digest as well. According to Bloomberg, the FTC is leaning toward appealing a ruling against its bid to block Microsoft's $69 billion acquisition of Activision Blizzard. Separately, the Financial Times reporting that SoftBank-backed chip designer ARM is in talks with NVIDIA for NVIDIA to join a group of investors to anchor its IPO. Last year, regulators struck down NVIDIA's planned acquisition of the company on competition grounds. It would have been worth over $60 billion.
Well, inflation continued to cool in June, rising at the slowest annual rate since March of 2021. Year over year, we saw core CPI rise just 3%. Joining us now, we've got Jens Nordvig, who is the Exante Data Inc. founder and CEO, and we've got Stephen Juneau, who is the Bank of America Securities U.S. economist. Gentlemen, thanks so much for taking the time here with us today. Jens, you're here in studio with us, so I'll go to you first on this. As we think about the headline figure that we saw, does this move the needle at all with the Fed, given that we've just had their meeting minutes not too long ago kind of spell out exactly how their tenor already was coming into not just this data, but also the next meeting too?
Yeah, so I think in terms of the next Fed meeting, like it's almost like the Fed is locked in. I don't think they're going to change their opinion about that. But really what matters for market is what the trend looking a little bit further ahead. And I think this number today is a very important number, right? We've had a huge debate about how sticky services inflation is going to be. And it's mostly the services that drives the core number, right? And this is the first reading we've had that has been less than 0.3 on the month for almost 2 years. And actually, if you look at the unrounded numbers, this number was close to 0.1. So this is a new situation. We've already had goods prices being very low. In fact, no goods inflation for the last 3-4 months, right? So if we also have the services prices starting to show some moderation, it's a very big deal for the Fed. So I think July is almost a given, right? But all that expectation that the Fed might continue to go beyond July, that is now in question, like you said.
Yeah. Stephen, I want to bring you into this. I mean, again, just to put a fine point on this, finally, right? It feels like this is finally cracking, that we are finally getting a little bit of relief. Put that in perspective for us. Like, how relieved should we be? Is this, should we believe this? Is it actually slowing down?
Yeah, well, first of all, thanks for having me on. And I would absolutely agree. We're finally getting kind of those softer prints. We're seeing that progress being made on the inflation front. As Jens noted, we did see core goods, ex-used cars. We've seen that flat for the last 3 or 4 months. I believe on a 3-month annualized rate, it's basically at 0.2. I mean, that's pretty impressive. I mean, it's not the deflation we were hoping for, but it is significant disinflation. We were running at 4.7% annualized in the first quarter. So that's really a big improvement. And you're also seeing shelter come down. You're seeing rent prices moderate. You're seeing OER come down. That was expected, right? You've seen that in the asking rent data. It's going to continue to evolve, continue to be a downward force on the inflation data. And now you also have used car prices falling. That was a big thing, right? The last 2 months were marked by used car prices increasing by 4% month over month or more. And now you get that 0.5% month-over-month drop, and you're likely going to see bigger drops coming in the coming months, and that's going to put further downward pressure on core. So I agree. I mean, some of these things may not repeat, right? They may not be as big. Airfares was a big decline, but I agree. This is a very soft report. We saw a lot of things to like, and we're seeing a lot of progress on the inflation front, and it's a continuation. You know, the last 2 months were marred by idiosyncratic factors, and now we're seeing those kind of fade a little bit, or really reverse and kind of push it down the opposite way.
Stephen, just as you were mentioning housing a moment ago, I want to kind of help make sense of this a little bit more, perhaps for my own edification and even that of some of our viewers as well, because we were talking earlier about how housing prices had accounted for 70% of the year-over-year increase, and yet coming down. So perhaps you could just help us break that down a little bit more.
Yeah, so you have to realize housing is the biggest component of the CPI basket, so it's always going to have an outweighed influence on the overall numbers. So that's what's been happening, but it's also a lagging indicator. So the way CPI does rents is it doesn't reflect what's really going on the ground floor, what's happening to someone who's taking on a new rent today. And what we're seeing in terms of what people are facing in terms of new rents and what we've seen in progress there over the last 6-9 months is that new rent inflation, asking rent inflation, is really moving lower. And what that means is that it's eventually going to catch up in the CPI data. We're seeing that already. We saw that step down in shelter inflation. We saw that continue this month a little bit. It's running at about a 0.4, 0.5% annualized pace, or 0.5% month-over-month pace, rather, instead of that 0.7, 0.8% pace that we saw to start the year. But now we're seeing that step down, and we think that progresses just given what we're seeing in asking rents. And again, it's a big share. It's the biggest component of the CPI basket. So as that comes down, we're going to see core CPI come down a little bit more. We're going to see headline come down a little bit more, and we should see inflation continue to moderate a little bit over the course of this year.
Jens, I want to linger on shelter inflation a little bit. And this is a conversation that's been going on for a little while now, that it's a pretend number, right? Owner's equivalent rent is something that is sort of made up. It's like, what would you be paying if you were renting the property? But should we just, do we just have to live with it at this point? Like the Fed doesn't seem to be, the BLS doesn't seem to be, they don't seem to be moving away from this measure, right?
No, I think the Fed is aware of this lag. Like Powell has been very explicit that he knows that there's some kind of lagged process there. And also the specific, everybody have their favorite breakdown of the CPI report, right? And Powell has a breakdown where he strips out those measures and looks at other core services, right? So in terms of policy, they're going to look at this holistically, right? And now we clearly have some improvement. And even if there's that lag, they're going to see increasingly through that. So I think it's a very important turning point. And it's going to ease, like those people who are extremely concerned about very persistent services inflation, they're going to be less worried. And I think the other thing I would say is that inflation expectations really have been under control for quite some time. Like obviously 2 years ago, the Fed was clearly behind, but they got kind of up to speed, and inflation expectations were never a worry, right? So like the argument for the Fed going extremely aggressively is that they're somehow like way behind the curve, right? Our inflation expectations are going bananas. That's not the case, right? So I think there's a situation where the Fed can say, okay, we've tightened a lot. We're going to do one more in July, and then we're probably going to take a break now. So this number makes that much, much more likely than before.
So that I'm feeling not bad out of all of this. Jens, you're going to stick around. Steve, thank you so much. Stephen Juneau, Bank of America Securities U.S. economist. Appreciate it. Let's dig into one aspect of the CPI report. Used vehicle prices were a major focus for economists heading into the numbers. We just spoke to Stephen Juneau, Bank of America Securities, a U.S. economist with us. He talked about used car prices, that they would be a major factor behind deceleration in core inflation. And indeed they were. Joining us now for a deeper dive, Yahoo Finance reporter Pras Subramanian, who focuses on autos. So what's going on there, Pras?
Hey, Julie. So, very interesting read here on the market following these numbers, these June numbers. I want to start with the new car market here. So for June, flat compared to May, and up 4.1% year over year, with that yearly figure coming down from May's 4.7%. But the used car market, like you mentioned, very interesting here. For June, down 0.5% compared to May, and down a whopping 5.2% year over year. That's a bigger drop than we saw in May's report of 4.2%. So we're seeing that actually come through here with that CPI data, that used car market moderating. We had some Edmunds data that we got recently from Edmunds direct to Yahoo Finance. They're showing the same thing: used car market down 0.6% month over month and down 3.7% year over year. That's at the retail average transaction level. So obviously what's happening here, I think, is that for new cars, you're seeing supply turning around, part shortages easing, cars in the lots, used car supply finally building up, more supply from cars coming off leases, the rental market. And I think higher rates are making it a bit harder to buy those used cars, and then that's putting pressure down on those used car prices again. So again, I think we're seeing some normalcy here from the pandemic where prices shot up considerably, and we're still trying to get back to that baseline.
One of the other things I'm seeing some chatter about this morning is car insurance pros. That I guess there was an uptick in accidents last year, and so we're seeing some of the insurers react to that. Is that something you're watching also?
I mean, I've seen some reports about insurance prices being higher overall because of EVs, because EVs are so expensive to fix and things like that. But I think you might be right about that, the trend there, because a lot more people are driving more post-pandemic, even these days. That's leading to more driving, more accidents, and we're seeing a lot of that kind of fall through with the insurers having to kind of pick up the slack there with all these body shop costs. So I think maybe there's something there. Maybe that'll sort of moderate as people maybe drive less, gas prices sort of come down a bit. We'll see.
We will. Pras, thank you. Appreciate it. So let's dig a little bit more into what's going on with the car prices here. Jens, when we see the numbers coming down here, I guess how encouraged should we be by that aspect of it? Since you don't buy a car very often, for example.
Well, it's been a kind of there's a bunch of fluky things going on in the CPI report. We have some extremely volatile items that are driving the numbers every month. Like, so last month it was those used cars, and we've had some airfares that were driving it. So if we model what's going on with the used car prices, we can report from Manheim and so forth, and what should be feeding into the CPI report with a lag, I think we have more fall in prices ahead of us. I think this 0.5% decline in this report doesn't fully reflect what is actually happening. So that could be a further disinflationary force in coming months. So it's always a tricky bit. Like, do you try to forecast those volatile items, or do you look at the whole CPI basket? I think it's nice to look at the median of everything that's going on, right? And it's been extremely low for goods for now 3 months, and that will be further emphasized by some of these specific items. Yeah.
Well, for potential buyers too, and the customers out there, they're trying to figure out, all right, is this the timing for me to buy? Should I get in right now and purchase that new or used vehicle, knowing that the financing terms might not be as favorable as they were a couple years back?
It used to be the case that a lot of auto companies offered 0% financing for 5 years in the United States, right? So if you think about that, getting a car where you literally have 0 interest rates, and now it might be 8 or 9%. Like, this is a pretty big difference, right? So in the last couple of weeks, we had a kind of strange debate where interest rates were going up, and a lot of people are starting to say, oh, interest rates don't matter for the economy. I think that probably feels a little bit differently today. And certainly in the auto sector, the impact is pretty dramatic.
Let's talk about the broader consumer for a moment, because inflation finally showing meaningful signs of cooling, it could be a welcome sign for the consumer, one would think. We have seen shoppers keep the U.S. economy afloat, although that's been more on the services side than the goods side. We know that you have been watching something called the Red Book Index of retail traffic and retail data. That's one of the many, many data points that you monitor, Jens. So what exactly is that showing you?
Yeah, I think I don't want to put a huge emphasis on one specific indicator, but I think what we are seeing right now is that there are a number of retail-related indicators that are kind of flashing red, right? So Red Book is one of them, but I think perhaps the more important one would be the consumer credit, right? So consumer credit was very strong last year. Some of the strongest numbers we've ever had. And the reason for that was that consumer balance sheets were very, very healthy because the government transfers in the COVID crisis were very big, so people didn't have to use their credit. But they used it aggressively last year, and now the numbers kind of show that either the credit card companies don't want to lend anymore, or people kind of feel, okay, maybe I shouldn't have such big balances, right? So there's something new going on there. I think that's very important, because if you look at what's happening in US consumption overall, this cycle has been a crazy cycle. Like, the savings rate has gotten to levels that we've really never seen before, incredibly low savings rate. So it would be no surprise at all if the savings rate became normal. Much higher savings rate means less consumption, right? So when you look at the next year, that I think is really the biggest risk to the US economy, that the savings rate just normalizes from a very, very low level. And I think these specific indicators start to smell like that is about to happen.
And so, even as kind of we compare this data against where the consumer is spending, or how they're spending rather, I mean, we've been looking at where they're also pushing more towards using or swiping their credit cards or tapping to pay, whatever they're doing these days, versus deploying cash, as evidenced by the New York Fed's figures that they put out. So how do you kind of compare what we're seeing in a report like this from CPI and where you're tracking with the Red Book data, how the consumer is spending right now? Does it show or signal any signs of either distress or moderation?
Yeah, I'll repeat what I said before. Like this cycle has had so many different elements that we've never seen before. Like this huge shift between goods and services, initially towards goods and then back towards services. That's a huge thing. We still have a normalization of consumption patterns around people working from home now coming back into the office. You're walking around the streets in New York, it really starts to feel much more normal, right? So there's a big shift going on. And when we look at numbers, we should never forget that the numbers are kind of like some aggregation of what's going on, right? If overall consumption is kind of okay because there's much more services consumption, people talk about Taylor Swift and so forth, and less traditional goods, it's still going to cause a lot of pain for the people who sell the traditional goods, right? So we might see that in the jobs figures for those sectors in coming months, right? You can't just average out. There's going to be pain in some sectors for sure.
It sounded like you tried to purchase tickets to the Paris tour then. That stopped for Taylor Swift.
Yeah,
No
that
comment.
made me wonder
No
too.
comment. All right,
Did you go see her?
No, but I would if I could get a ticket.
If you'd been able to sign in, huh? Something like that. All right, well, we hope that Ticketmaster fixed those issues. I think they did. Anyway, yeah, stay with us. We've got much more to discuss, and we'll get your concert picks for the summer as well. Also, we've got to talk about momentum in China's post-pandemic recovery. It's not going exactly as planned for the world's second largest economy. Deflation concerns continue to cloud China's economic backdrop after the country's annual CPI was flat in the month of June. That's the lowest print since February 2021. But are investors being too pessimistic over the uncertainty of China's economy? Jens Nordvig, founder and CEO of Exante Data, is still here with us. I saw you kind of moving around in your seat as we said, are we being too pessimistic? Are we being too pessimistic about China, or is it warranted? Some of the concerns that we've seen initiate from Wall Street and the global economy and economists as they're trying to figure out, all right, what is China showing us in the data?
We're living in this world where almost every week we have to deal with some kind of rumor that there's a new stimulus coming in China. Like literally almost every week we have some kind of pop in the market, right? This week we had oil prices popping that was linked to the rumors about property market stimulus, right? And I'm not saying we're not going to have any stimulus in China. They're probably going to do something to try to ease the pain in the property market. But the issue is that we've had at least a decade of dramatic overbuilding in China. The demographics are horrible, right? The demographics in China is one of the worst trends in the whole world, right? That is very important for the housing market long term, right? So there's no easy fix. They just have too much property having been built, right? So it's very hard to stimulate their way out of that, especially since they stimulated very aggressively after the global financial crisis, right? They have a huge amount of debt in the system, right? So I don't think these old tools to revive the Chinese economy are going to have much effect at all, right? So it doesn't mean oil can't bounce for a day, right? But the trend in China is going to be problematic. And I'll just make one more point. We've been used to China being the manufacturing hub for the whole world, and it still is, obviously, and we can see the competition in all kinds of sectors. But the big change that has happened over the last 9 months is that multinational companies, right, are not investing in China in the way they used to. During that part of the COVID cycle where everybody wanted to buy a new coffee machine and so forth, multinationals were investing as much as they could in China to try to produce as much to satisfy global demand. There was around $300 billion coming in, foreign direct investment, to build that capacity. Now we're down to 100. This is a big, big swing. That $200 billion swing is investment into Mexico, Vietnam, Thailand, and so forth. People want to diversify their supply chains. That's a big, big problem for China if that support is going away.
We talked to an investor earlier in the week who had an interesting thesis on China where he talked about rather than exporting goods made in China on behalf of other brands, that we're going to enter a phase where China is exporting its own brands more into the West. We're seeing that, I guess, a little taste of that with the likes of Shein, or however you say that, Shine, Shein, whatever.
Shein.
But that, you know, cars, for example, will be coming into the U.S. market, et cetera. Will that be the next big growth engine for China, do you think, or will it never make up for the former push of growth?
Yeah, so the cars is a complicated thing because if you look at in the numbers, you can already see that China is taking dramatic market share from European producers, Japanese producers. They're mostly taking the market share in emerging markets, right? So if you go and travel in Latin America, you'll see, okay, it's actually mostly Chinese cars that are being sold, right? So that's already happening. Exporting Chinese cars into the US is much more complicated for tariff reasons, for regulatory reasons, and so forth. Same into Europe. So you're not going to see it as much in those two markets, but you're going to see it globally. But nevertheless, right, China has benefited tremendously from all these big multinationals concentrating their supply chains in China, and they don't want to do that anymore. So that is going to be a negative, even if China is trying to push their own products.
Really interesting. All right, we want to move on and talk about currency, which I know is a love of yours as well. The greenback, the dollar that is, closed out 2022 with its best performance in 7 years, not surprising considering the Fed's aggressive rate hike campaign. Despite the odds repricing on hawkish Fed bets, it's been a slightly different story this year, though. The U.S. dollar recently slumped to its lowest level in 3 months, showing that bullish bets may be losing steam. So let's talk about currencies and how then it's going to affect other assets. Jens Nordvig of Exante is still with us. So Jens, what's going to happen with the dollar if indeed we're seeing inflation moderating and maybe the Fed finishing its interest rate increases?
Yeah, so I think certainly how much the Fed is going to do is obviously important, right? So that element is clear. But I think the other thing to keep in mind is that the dollar had a historical run, just a historical run from 2014 to 2022. And we had like just a perfect storm in 2022, right, with, like we talked about 75 basis points per meeting. At some point we talked about 100 basis points per meeting, like just incredible hawkishness from the Fed. We also had asset price weakness globally that tends to kind of support the dollar from a safe haven mechanism. We had an acute energy crisis in Europe. We were talking about can Europe survive because of the war and so forth. This was a very dramatic situation. The dollar got to kind of a peak September last year that it's going to be hard to kind of surpass, right? So this year has been much different. And I think what is very interesting in terms of how the dollar has been trading is that even in those periods where we've had repricing higher in the US yield curve in February and again in May, the dollar benefited, but just a little bit, right? It was not like strong momentum. And I think that shows that the dollar has been close to peaking. You can think about it from a valuation perspective as well. Like, where is the dollar relative to history? We have tons of models that do that. I'm just going to give you one model. If you sort of average all the models, you're at least 10% overvalued relative to fair value, right? So that's kind of what's like constraining the dollar's ability to go further from here. And this is pretty important for the outlook.
So what is the comfortable trade that someone can still look to within currency assets right now?
Well, there's many different ways to trade a weaker dollar, right? You can trade gold long. If you think global interest rates are peaking out, gold long is probably going to work out well. You've seen in the last week or so, the yen has finally started to regain some strength, right? So that's certainly a currency that has weakened, 20, 30%. If it starts to move, it can have big moves. So those are options. The other end of the spectrum where you have very high interest rates, that's going to benefit the carrier of your trading, is Mexico. Mexico has very attractive high interest rates, very strongly performing currency. So there's different ways to express a dollar bearish view.
Jens, you track a lot of data sets, as we know. What's the most esoteric data set that you track, and what is it telling you?
So we have like a massive database of alternative data, capital flow data, and that kind of thing. It changes all the time. What is the most important? In March, the most important data we tracked was the daily data on the deposit outflow, right? In January, it was the Chinese reopenings, all the alternative data there, right? So we shift our focus all the time. I gave you that foreign direct investment data point. I think that's a very important data point now. But I think actually anything to do with consumption, savings in the US, I think we're in the inflection point. So we're going to be focusing aggressively on any type of data that gives us a read about whether that savings rate is going up and consumption is going down.
I wonder what the Taylor Swift ticket price index is telling us right now. Nothing good for people who are trying to buy it. All right, Jens Nordvig, great to see you. Thanks so much for spending so much time with us today. Jens Nordvig, of course, is founder and CEO of IXIC Data. Well, we've got much more markets action coming up ahead, the opening bell as well. Stay tuned.
What story is not being talked about enough this year?
I think the story that's not being talked enough is this concept of the recession that everyone's expecting may actually feel and look a lot different. And so we're of the belief that we're actually seeing rolling recessions. And so what's important to investors is really about, are we in a profits or earnings recession? Yes, we do believe that there's going to be an economic recession, but when we look at profits recessions, last year, we saw a profits recession in 7 out of the 11 sectors in Q4 of last year. You could argue technology was in a profits recession last year as well. And so instead of this feeling like everything all at once, it really is going to be this rolling where parts of the economy, like manufacturing, are seeing declines, but other parts seem resilient.
We just had the opening bell on Wall Street, so let's do a quick check of the market, sponsored by Tasty Trade. All three major averages in the green. It looks like investors are quite happy about inflation moderating as measured by the CPI, Consumer Price Index. So the Nasdaq up by 1.25% today, the S&P up 0.9, and the Dow rising by 0.2%. It seems like, Brad, that people are sort of extrapolating that the Fed will not need to be as aggressive with interest rate increases beyond the meeting at the end of this month.
Yeah, as long as we're getting closer to that target, perhaps there's a little bit more relief that will enter into the equation, that it's not as persistent, at least on the inflationary front. There are some areas where we hope that continues to move lower, especially for those prospective home buyers out there and prospective vehicle purchasers. But as of right now, taking a look at the Dow Jones Industrial Average here intraday to begin today's activity, as we're just about 2 minutes into the start of trade, that's higher by about 0.7% here. I'm just going to retoggle back over to this in a moment here so that we can make sure that that's loaded up for the Nasdaq composite. That tees up our view of the tech-heavy average. That's higher by about 1% to start off today's activity. And the S&P 500, you're seeing that up by about 0.8%. Let me populate this chart for you here so you don't just have a blank chart that you're looking at home. There you're seeing it over the last 3 days up by about 1.8% for the tech, for the S&P 500 here. Well, speaking of tech, let's take a look at XLK. Why not? That's one of the sectors in the S&P 500. And taking a look at all of the sectors right now, 11 of them, we got them loaded up for you here on screen. We're green across the board here. We're being led by consumer discretionary. That's up by about 1.4% right now. And then the rest of the way, you're seeing some green. So we won't linger on that too much. And ton of green here on the Nasdaq composite. Well, the Nasdaq 100 at least. You've really only got, you can count them on two hands, how many laggards there are right now. None more so than Lucid, though. Lucid's down by about 4% out of the gate this morning. Also taking a look at Activision Blizzard here. We're going to discuss some deal-making news in a hot second. That's down by about 1%. But just to give you some context here, over the past 2 days, this was one of the top trending tickers on the Yahoo Finance platform yesterday and was so this morning as well. When I checked it, past 2 days, that's up by about 8.9% and a whole sea of green. So with that, let's talk a little bit more about it, Julie.
Yeah, let's do it. All right, thanks, Brad. Microsoft, as Brad was talking about, earning a big win in court Tuesday. A federal judge denying the Federal Trade Commission's request for a preliminary injunction, which was meant to stall Microsoft's $69 billion deal to buy Activision Blizzard. This coming as this morning, Bloomberg reports no final decision has been reached, and that we actually could see the FTC appeal that decision. So it doesn't look like the stocks are reacting in particular to the report that there could be an appeal here, right? In other words, if the market was judging that the FTC, A, was going to appeal, and B, that it had some chance of success, you would perhaps see Activision pulling back more. And instead, we're just seeing sort of a day two, little bit of a come down here.
Yeah, Bobby Kotick as well, the CEO of Activision, had put and published a statement through the Activision Blizzard newsroom or blog, just saying that they were grateful to the court for the way the process was handled and the thoughtfulness of the decision. U.S. joining now 38 countries where the deal can proceed. And these decisions, Bobby had said, are based on facts and data that show that their merger is good for players and competition in the industry. And so we will see exactly how shares continue to react, no doubt, with the consummation of this deal looking more likely, at least in those countries where this deal has been allowed or given the green light. And now, to see if some of the other regulatory action or at least allegations begin to be retracted at least a little bit. We'll see if that takes place.
Yeah, and there's a big discussion now and big implications for what's going to happen with tech deal making. There's one deal that got rejected last year. NVIDIA was trying to buy ARM. Now, according to the Financial Times, NVIDIA is reportedly holding talks with ARM, the British chip designer, to perhaps be an anchor investor on ARM's IPO. ARM now controlled by SoftBank, which has been planning to spin it out in an IPO. And there's now this talk of anchor investors who might take a big stake in the company as part of that initial public offering. And it is interesting, given NVIDIA's history here of trying to outright buy ARM and then getting rejected by regulators.
Yeah, and there's a long history of companies who, if they don't feel like there's a pathway for them to be able to acquire a company, to have that type of either anchor position or some type of outsized shareholder or stakeholder position in a company that's getting ready to go public, even if they do play in the same space. I think back to when Trivago went public even. Expedia was one of the major shareholders in that company at the time of their IPO. You can look at some of the other examples, especially within the ERP landscape, where there have been either early angel investments. I think back to none other than Salesforce.com. And when they went public, of course, Mark Benioff, given his position that he had previously at Oracle and the relationship with Larry Ellison. Larry Ellison was a major investor in Salesforce as well. And so there are all these different examples, and this could perhaps be one of the latest where, in the face of regulators pushing back on a deal being able to go through, where there would be a stakeholder position that's taken on in the advancement of an IPO as well, and entry into the public market.
I should mention I reached out to NVIDIA for a comment and did not hear back. Just one other quick note about the Financial Times report is that at the amount in which NVIDIA would invest, it would value ARM at $35 to $40 billion, which $40 billion is originally what it was going to buy the company overall for. SoftBank was hoping for a valuation of about double that. So we'll see what ends up happening.
We will indeed. We're also tracking shares of Cody.
We are. Yeah. I like, is that the sign for makeup? Shares of Cody.
That was me trying to cover up the fact that I had messed up this read.
All good. Shares of Cody are up about 1.4% today on a report that media mogul Kim Kardashian is in talks to buy back her stake she sold to the cosmetics company in her skin brand. According to the Wall Street Journal, there's not a confirmed sales price yet. Talks may break down before reaching a deal, they said to people familiar with the matter. Cody bought a 20% stake in Kim's brand, KKW Holdings. It now goes by Skin by Kim. 3 years prior. The shares were up a lot more in pre-market trading.
Yeah, they were.
And now they're only up about 1.25%.
Yeah, so we'll see if this is effective for Kim Kardashian. Of course, the I almost called it the Kardashian engine, because that's what I've called it in the past.
Engine. I
mean, that's what it is. The business of Kardashian it's an engine. I mean, there are so many different forays that they've made, either into apparel or footwear or skincare, and really driving some of the influencership that's taken place across social media for the better part of a decade now. And so all that considered, the skincare and cosmetics portion of that has been one of the most lucrative forays for whether it be Kim, whether it be Kylie. We've seen that essentially make them billionaires, if not already just cementing that status. And so now for Kim Kardashian, seeing exactly where she can perhaps take back some of that ownership of her own brand too.
Yeah. And now we're going to go from to, what's the sign for pizza?
I don't know.
There you go. I like that one.
It's just tossing it up in the air. Well, let's take a look at shares of Domino's Pizza here as we're getting the mimes in full motion here this morning. The stock moving higher after the pizza chain announced it's teaming up with Uber on its delivery orders. U.S. customers will be able to purchase Domino's Pizza products through Uber Eats and Postmates. Now, the agreement has been said to roll out this fall. Take a look at shares of Domino's Pizza here this morning, moving higher by about 12%. And for Domino's, one of the companies that was very early on in its technological acceptance of how they could engage with consumers, whether that be through their own website at first, or making sure that they had an app experience, or even being one of the first pizza chains where you could tweet to order. I think they've been very advanced in how they're making sure that they take on data, but also how they're engaging with consumers. I think, though, that this is an admission that they can't do it alone.
Right, exactly. They had been basically the last holdout. The other major pizza chains already work with the external delivery companies, and Domino's was holding out here. So it's quite interesting that indeed they have said, okay, now we're going to do it. There was some interesting data that the Wall Street Journal put in its story today, citing a research firm called Circana. They said Uber, DoorDash, other apps that people use for delivery accounted for 14% of pizza sales in the year ended the end of May. So, people are, while Domino's is definitely doing its own thing, that's 14% is a decent chunk of pizza sales.
I wonder of that percentage, what is representative of the large chains, the U.S. national chains,
Right.
versus some of the mom and pop shops? Because in New York, we got a lot of great mom and pop shops, Rocco's Pizza. But, you know,
Jersey has them too, I gotta
Jersey
say.
got them too. But, you know, you get a good grandma slice in New York. I don't know if you can get the same thing from some of these national chains. And it'd be interesting to know where consumers continue to flock to.
Yeah.
Because there are, for the chains, a lot of the propensity or the ability to make or drive huge promotions. They're marketing businesses that then have different franchisees underneath of them versus some of the local shops that are really just trying to make sure that the deals that they're offering are not going to cannibalize perhaps their profits at the end of the day, while still trying to make sure that there are add-on purchases that consumers are making when
You
they're
know who
buying.
we can ask?
Who's that?
Slice. Slice is pizza delivery app
haven't
that
tried
works
that
with a
one.
lot of moms and pops.
I gotta try that one.
Yeah,
All
do
right.
it up.
Into it. We're going to order right now, guys. Let us know your order. All your markets action straight ahead. Tweet at us what your favorite pizza is, I guess. I don't know. You're watching Yahoo Finance. Have you tried Threads yet?
I have not. No, I have not. I hear good things though, so I'll leave it at that.
Okay, it's early days. I know I was in the tens of millions that first signed up for it, so I guess that's all I have going for me right now.
Well, if you're an active user, then you can coach me on it.
Okay, I will report back on that. Stocks pushing higher following the release of a better than expected June inflation report. Let's get to Yahoo Finance's Jared Blickery on the floor of the New York Stock Exchange for more. Jared, what are you hearing? What are you seeing?
Brad, I'm seeing a lot of green on the Wi-Fi Interactive here, especially over this week, this just 3 days. We're looking at the price action. Here's the Dow. Dow is up 2.3%. S&P 500 going to be a little bit less than that, and that's the benchmark. Nasdaq still not up to quite the Dow levels, about in line with the S&P 500. And here are the small caps just screaming out of the gate today. Another 1% added to the total brings the total over 3 days up to nearly 4%. Transports were leading up yesterday. I noted that, and we got into a little bit of a Dow theory here. And I just want to show you the sector action. We're seeing a repeat of this theme here. Here's today, everything in the green except for healthcare. Over the 3 days this week, energy and financials, that's XLE and XLF, value is leading. Then we have industrials, that's cyclical, and then we have some mega cap sectors from communication services, retail looking positive as well, and then real estate. That's a broad-based mix of sectors. I look at my leaders, everything in the green there. Disruption in terms of our components. Those are leading the way up 8%. Memes doing well, gambling, home builders, regional banks, and the list goes on. And then I take a look at the S&P 500. This is a year-to-date view. We just broke all of this resistance here that we had seen over the last 3 weeks, and we are up at new highs for the last 52 weeks. That is a new 52-week high. Here's the Dow. It is at its highs from about a month ago. And here's the Nasdaq. It is broken above just barely that high as well. And finally, here's the transports. I noted that it had broken up yesterday and a little bit of red in that candle today. But all in all, we shouldn't be surprised at this narrative that's emerged here. I said a few weeks ago on the Russell rebalance date, that was the opportunity to trade a lot of shares, and we're not going to have a lot of that throughout the rest of the summer. So this morning's report only added to the narrative that we're going to stay higher for longer, and we're not going to have any kind of recession that takes away GDP growth. But is that realistic? I think the market continues to build on good news and continues to discount bad news until there's something to dissuade the market. And that would be a rapid deterioration in the data. That could come from some earnings announcements, and we're going to get those starting later in the week, or that could come from the economic data. But as we saw this morning, the economic data certainly pointing to the former scenario that traders have embraced, which is that the market can stay higher for longer without suffering too much of a hit in the economy.
Yes, and I think consumers can embrace those numbers this morning as well. Thanks so much, Jared. Well, from sparkling water to frozen treats, Nestle has a global footprint that raked in over $100 billion in sales in 2022. The consumer staples brand owns companies like San Pellegrino, Haagen-Dazs, Nesquik. It casts a wide net over different sectors of the food space. But as we just talked about, we are watching inflation data very closely. Continues to bite into consumer spending habits, even though it's getting a little bit more moderate. How's a brand like Nestle adjusting? Steve Presley is joining us, Nestle North America CEO. He's joining us alongside Yahoo Finance's Brooke DePalma. So Steve, thank you so much for being here. I do want to start on inflation. We did just get the numbers this morning that do show consumer prices moderating a little bit. I know that Nestle globally has been raising prices, at least earlier in the year. Can you give us some color on what is happening now with your pricing strategy?
Yeah, I mean, look, we know inflation has impacted our consumers across all the categories that they buy, including food and beverage. And for us in North America, we've also been raising prices across the last couple of years. I think, thankfully, we're starting to finally see this inflation moderate a little bit, that we're seeing it come through the business in a pretty good way as it slowly starts to moderate. We're still at pretty high levels. I remember actually on this program a couple of years ago, we were having a debate around whether this was transitory inflation or scarcity related. And clearly we see there's some structural elements to it, and there are definitely some transitory elements. So it's different by sector in terms of where we see the inflation softening. But overall, at least the trend's going in the right direction again.
Definitely the right direction for consumers. Can I read this to mean that you all have stopped raising prices for now, or just that the price increases are getting smaller?
No, actually, for North America, we hope we're generally done with price increases. You know, you can never say never, obviously, as the market continues to fluctuate, and it's a live being, as we know. And so as it continues to move, I think for the most part, we think the peak inflation is behind us, and it'll start to slowly work its way down. We've actually leaned in pretty significantly as it's starting to soften in terms of investing in promotion, investing in advertising behind the brands to redrive engagement with consumers and actually help those challenged consumers come back to the categories.
Good morning, Steve. You've been making some pretty big investments in the coffee category. I mean, you have brands across the board from Starbucks, Nescafe, Nespresso, pretty popular among younger generations. Are you seeing continued usage of these sort of machines, of these sort of products at home? And is that COVID-19 impact sticking along, or are consumers going back out for their coffee trips?
Yeah, thanks for the question. Yeah, it's great. It's actually, when we called it the at-home revolution that started in COVID. But the trends are actually sticking. What consumers learned is they can make these amazing, great products at home. And all of our products, whether it's our Starbucks at home or our Coffee Mate or our Starbucks creamer brands, we can deliver incredible products at home with the same out-of-home quality, actually at a significant value proposition versus out-of-home. You know, one example is if you buy our coffee and our creamer for 20 cups, you can actually make 20 cups at home every single day for the price of one out-of-home cup. So as consumers continue to be strained in terms of their value, dealing with this inflation, those products actually provide a great value proposition for them. And so the trends are great. Actually, not only are the trends great in machines, but they're great in terms of the day parts that we drink coffee. Cold is absolutely a phenomenon. We all drink cold coffee. We drink espresso has really caught on. All of the segments on where coffee can serve continue to grow at a very fast pace.
There's been a lot of rotation, Steve, of some of the brands that Nestle North America holds on to right now. Have you looked across the portfolio and identified anywhere that you would like to kind of reinvigorate even more growth, areas where you could see Nestle North America making a strategic play or an acquisition?
You know, actually, North America has been a core growth driver for Nestle SA for the last 5 years, and we continue. So we actually look to accelerate growth on all of our businesses, and we're quite proud of the progress we've made over the last 5 years to really grow. And we're in the quiet period for H1. But if you look at our Q1, North America actually grew almost 12% across roughly a $30 billion business. And we continue to see that momentum as we move ahead. And so for us, we are active in portfolio management. We believe in being in the right portfolios where consumers are most engaged. And we're really happy with the portfolio we have right now. But we continue to look to find other categories and either deeper within categories we're in to further engage with those consumers over time. We think there's still opportunities in this marketplace. We're very bullish on the strength of the U.S. consumer and the U.S. marketplace, and we continue to look for opportunities.
Steve, when you look across your portfolio in the U.S., sort of linked back into this brand conversation, but also the pricing conversation, are you seeing some trade down where people are going to store brands versus Nestle name brands? To what extent are you seeing that?
It's really different by every single category. There's not one trend you could say. There was absolutely a trend where consumers moved away from store brands during the peak of the COVID crisis. And the stores are regaining some of that. So there is kind of a general momentum to store brand. But some categories we're seeing very strong trade down. In other categories, we're not really seeing it at all. You know, pet care, for instance, there's some trade down, but in most of the categories that we participate in, we don't play with one brand at one price segment for consumers. If you take pizza, for instance, you know, we have very high-end pizzas at California Pizza Kitchen to DiGiorno to Jack's to Tombstone. So as the consumer moves through the category, that's the strategy we generally approach against all of our categories, to where that trade down, we hope they trade down to ours, and we continue to try to offer value for money in every single one of those segments. And so whether it's coffee or pizza or pet care or all of our major categories, we try to offer the broad spectrum of products so consumers can move down if they need to.
And speaking of that pizza, you're joining us exclusively from the TED Countdown Summit. You're set to make a major announcement around the DiGiorno wheat supply chain. Break down exactly what that investment is and how much it will ultimately cost Nestle North America.
Yeah, look, for us, we're here to talk about regenerative agricultural practices, and it's a word that gets used a lot that very few people have a foundation of. But I think of it simply as, look, by the end of the crop cycle, did we leave the soil better than it was when it started? And that's really what regenerative practices do. And if you think about it, it sounds like this very academic or kind of esoteric description, but it can be really simple practices like crop rotations or just no-till or low-till farming. And it's working with those farmers. And specifically around DiGiorno, we'll announce a partnership with ADM and other partners for wheat, which is the foundation, obviously, for the crust. And we'll move to actually 100,000 acres of regenerative agriculture or farms that will actually practice regenerative practices, which will give us double the amount we need for the overall DiGiorno business in terms of sustainable wheat. And so, look, there is an investment. It's a transition for farmers. You're asking farmers to change the way they farmed for the last 100 years. And we understand that all that kind of transformational change is challenging. And we're willing to invest and lean in with them, because the way we approach this, it can't just be good for Nestle. It has to be good. And we talk about it in terms of creating shared value. It has to be good for Nestle. It has to be good for the farmers. It has to be good for our consumer. And ultimately, we believe it's the right thing to do for the planet as well. That's why we're willing to invest in it.
Yeah, Steve, spot on. Look, you've got the right folks here for this conversation. I mean, I'm originally from Pennsylvania, where we've got one of the top agribusiness and agriculture conversations taking place in the country. And so when you think about that and all of the focus around regenerative agriculture, to what extent was this prompted by climate change?
Look, obviously, we have a role as the largest food and beverage company in the world to try to lead our industry around climate change. And we think about it, look, we know roughly 30% of total greenhouse gas emissions come from total food production. And at the core of that is agriculture. And for us, driving agricultural changes and get to this regenerative practices will make tangible differences in this climate journey. And it'll help us achieve. And we can't achieve our net zero roadmap if we don't make structural and systemic changes through that agricultural complex. And that's why we're so focused on it. But really at the heart of it, what it really gets down to, we're a consumer-focused company that when you think about it, we want to make great products for our consumers every single day. And that starts with great ingredients. And for us to have great ingredients for the next 150 years, like the past 150, we've got to take action now and improve the quality of the biodiversity and soil that we actually operate in across all our farms.
And Steve, correct me if I'm wrong, but this seems pretty costly here. And you're also working across the tomato supply chain to do something similar. Let's talk endgame here. What does this ultimately mean for prices at the grocery store for consumers when they go to get their next DiGiorno pizza?
We actually don't think this is a problem you can pass to the consumer or an opportunity that you pass to the consumer. And it's not a problem you pass down to the farmer. It's one that collectively we have to solve. And we think it's the right thing to do for the business. And managing the crop cycles and managing your supplier base is just part of what you do when you run these businesses. We will invest massively. Globally, by 2025, we'll invest over $3.6 billion, over $3.5 billion in these regenerative sustainable practices globally. And clearly that has a cost impact to us, but we believe it's the right thing to do for the business long term, and the idea is to not pass these forward to consumers. We believe this is the right thing to do, and we've seen in test farms that we've developed, we actually see higher yield once the practices get going. And so we're encouraged that actually not only will it give us regenerative, better soil, better biodiversity, but ultimately will give us better yields out of those same farms.
Really interesting stuff. Thank you, Steve. Really appreciate it. Steve Presley, Nestle North America CEO, and our Brooke DePalma. Be well, Steve. Thank you.
Thanks, guys. Take care.
We got much more markets action coming up ahead. You're watching Yahoo Finance.
What has been the stock story of 2023?
I would have to say it's AI. I know everyone's saying that, but I would say artificial intelligence dominated Q1 earnings. Certainly when you see the returns, it's been concentrated in a few really mega cap names. But the interesting part of this is, on one hand, it's about artificial intelligence, but then it's also about the fact that these are companies with massive free cash flow generation. So part of it is the story about technology, innovation, AI, but then the other part is, what's the major theme? If you have positive free cash flow generation, you have that money to fund innovation, you have that money to fund further growth, and that's what the market's going to continue to pay attention to.
We have got some great interviews coming up in the next hour. Investors have been plugging into Rivian recently, but what does that rally mean for the state of EVs overall? We will discuss.
Plus, we'll head to the White House to get a pulse check following that inflation report with Jared Bernstein from the U.S. Council of Economic Advisors. You don't want to miss that conversation. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. So we have to know, is the worst of inflation behind us?
I think the worst of inflation is behind us. We see inflation coming down at the end of this year to about 3.5%, with some potential to then get down to about 2.5% by the end of 2024. The thing is that journey from 3.5 to 2.5 to 2 is going to be a complicated journey, but I think what the market is really looking for is signs of that abating, and particularly within the services sector. So if we start to see more deceleration in inflation in the services sector, then I think that'll be enough for the market to really feel and see the end.
Welcome back, everyone. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We're about 30 minutes, just a little bit over that, into the start of trading. So let's take a look at how stocks are faring right now. The S&P 500 moving higher after consumer prices rose at the slowest rate since March 2021. Core inflation accelerated 4.8%, still above the Fed's target, but low enough to make investors more confident that an eventual end to the hiking cycle could be upon us. We are still awaiting for some Fed speak, as well as the Beige Book this afternoon set to come.
Looking at individual names, shares of GoodRx are surging today on news. They're joining forces with CVS Caremark, the duo launching a new product, Caremark Cost Saver. They aim to help customers save on generic drugs at all eligible pharmacies. That new plan taking effect next January. That gives plan sponsors and employees time to opt in. GoodRx co-founder Doug Hirsch told Yahoo Finance that this new relationship gives the company access to 70% of commercially insured Americans following their partnership with Cigna's Express Scripts.
And Redfin is pulling back from a 15-month high this morning after D.A. Davidson analyst Tom White wrote in a note that the stock rallied too far and it's time to sell. He said the real estate services company made progress towards its profitability goal, and it is now fully reflected in Redfin's current valuation, so it doesn't have much farther to go. Also saying that the 3 rounds of layoffs won't be enough to improve the downturn in home listings.
And we're also watching shares of DraftKings. They are surging about 5% today after a Bank of America analyst said the company is reaching an inflection point. The bank upgraded the gambling company to buy from neutral, saying that revenue momentum and market share gains could drive that inflection in margins and profitability. DraftKings has already outperformed year to date, the stock up over 170%. Well, inflation data this morning showing further signs of cooling as investors look for hints of what's to come from the Fed's July meeting. What did the data tell us specifically about the state of energy prices? Yahoo Finance's Inez Frey joins us now with the details. People always watch gasoline very closely as a sort of proxy for consumer prices, but it is more complex than that.
Yeah, that's right. And so we have seen that energy last month was up 0.6%, the energy index. Now that includes all things like gasoline, like fuel oil. Now remember that in the previous month, energy had fallen 3.6%. So you are seeing a little bit of volatility month to month, but year over year, energy is down 18.6%. In fact, out of all the categories, it's the one that's down the most. What a difference a year makes, because energy was so volatile last year and it made up so much of the CPI last year. Now, if we take a look under the hood, why you saw energy going up 0.6% in June, well, gasoline, as Julie was mentioning, that increased 1% in June. But remember, the prior month, it had decreased 5.6%. So some volatility there. Electricity increased 0.9% in June after falling in the prior 3 months. Year over year, electricity is up 5.4%. So if you did see your electricity bill go higher this year, well, you're not alone. The natural gas index, that has been on a decline. That decreased 1.7% in June, the 5th consecutive month of a decrease. And fuel oil, that declined 0.4% in June. Year over year, fuel oil is down 36.6%. Now remember that the energy index really impacts so many other things because it impacts jet fuel, for example. And we saw that the airlines had come down as well, so airfares. So really, you are seeing a downward trend when it comes to oil, and oil had been trading, right now it's been trading at a 10-week high. We are seeing the dollar weaken a little bit, so that is helping boost oil prices a bit today as well.
Okay, so what should investors be keeping in mind, even as inflation kind of paired with the energy data that we're continuing to track too, that's going to have at least some outsized weight on where they're kind of placing their portfolio bets coming off of this news?
Yeah, and it all really depends on where you think oil will be heading for the second half of the year. Look, there is still a lot of bullishness when it comes to demand coming out of China, that demand for oil in China. You are seeing the EIA that just came up with its demand forecast for 2023. You have the supply cuts that are coming out of Saudi Arabia as well. So that should impact oil going into the second half of the year. But of course, the big red herring is what happens with a recession in case of a recession, and what happens with demand if there is a recession, and how severe it would be.
Great stuff. Yahoo Finance's own Inez Frey. Inez, thanks so much for breaking that down for us. Well, this morning's inflation print came in cooler than expected. Consumer prices rising just 0.2% month over month, 3% year over year. Despite this easing, the probability the Fed will move forward with further policy tightening has gone down just slightly. It's now at about an 88% chance of a 25 basis point rate hike in July. That was 90%, and according to the CME FedWatch Tool. So could higher for longer rates threaten the possibility of a soft landing? Joining us now, we've got Ludovic Subran, who is the Allianz chief economist, and Preston Caldwell, Morningstar Research Services, LLC, chief U.S. economist. Great to have you both here with us today. Preston, I mean, take us through your thoughts, even as we had seen this print come through earlier on and the propensity for the Fed to already signal, or at least for the markets to believe, that the Fed is going to raise at their next meeting.
Yeah, I don't think today's report was ever going to be that consequential for this month's meeting for the Fed, because the Fed's never going to overreact to 1 month's worth of data, and for good reason. However, it does provide a confirmation of our view that inflation is headed downward. And if that continues to play out, then the Fed will eventually pivot to cutting in 2024, we believe. Which appears to be the view towards which the market is moving today, with 2-year Treasury yields down about 17 basis points, which implies a substantially looser path of policy over the next 2 years.
Ludovic, will the Fed heed this data? In other words, this is 1 month. We have seen the trend improving. Is there still a risk of a so-called policy mistake here?
Look, I mean, one thing is sure is that the Fed will not get derailed by 1 month at 3%, right? Because there's a huge base effect, and somehow it's still 3%. And the last thing is we still see the transmission, the pass-through. Shelter is now the last domino of the game, right? So I think the Fed will hike in July. There is absolutely no doubt. The real question is whether they will hike again in September for me. The reason for that is because, when you look at the monthly rates of inflation in the US, even with 0.2 or 0.3 on month, which is not a lot, you still get, close to 4% by year end. So it's still too much. And so, yes, there is a risk of a policy mistake. There is a risk of manufacturing the recession and the hard landing. And remember, the numbers that we're going to see that in the beige book, I guess, is the financial and monetary conditions in the US are getting super tight. So the problem here is to understand what is the risk here that they keep rate high too long, and that this trickles down to the real economy.
Just to follow on that, does that mean that the Fed doesn't need to kind of enact policy all the way until 2% is struck, or do you believe that there should be just kind of some waiting and seeing to see where the economy, where inflation specifically, can get down to their target without having to forcefully do so?
Well, I believe something is sure, transmission uncertainty is high. The lag effect of monetary policy to the real economy is a bit tweaked because of many things, excess savings, the order books, the massive transfer of wealth from the public sector to the private sector, and so on and so forth. So I think the problem here is this dislocation is creating a bias for the Fed to wait out a bit more because they don't want to be uncredible with their mandate. So that's why this data dependence that is in every central banker's mouth is, for me, a policy making a mistake, because the role of the central bank is to provide forward guidance. So first, we risk a high correction on the market, a 22 type of event. And second, by the time we see the full transmission, it's going to be too late. So if you pivot too late, then you're going to have a jobs market issue. And so that's a bit the trade-off that the Fed has to face. Is it really worth it going all the way to 2%, but have 6% unemployment rate? Or is it okay to be in a 2 to 2.5% range and you are good with 4% unemployment? And that's something that is not being discussed enough as we speak here.
Preston, do you agree? Do you think the Fed needs to be more transparent about that trade-off? I mean, it's interesting because it feels like Fed Chair Jay Powell has been fairly, I don't know if cagey is the right word, right? But perhaps not willing to acknowledge the full extent of damage that the Fed could potentially do.
Well, a few points. First off, I don't necessarily agree with the nature of the trade-off. I do think by 2024, early 2024, inflation will be approaching 2% in year-over-year terms, even without a severe recession. But supposing that the trade-off is true, I do think, the Fed is very reluctant to deviate in its rhetoric from its adherence to its 2% target, and for good reason. I mean, the very fact that people in the economy believe that the Fed is adhering to a 2% target may be crucial for inflation eventually returning to normal. So I don't think there's anything wrong with the Fed being a bit cagey on this point. For now, the Fed still needs to stick to 2% officially.
What they have discussed, at least as apparent in their own meeting minutes here, is a mild recession starting later this year, followed by a moderately paced recovery here. What is the reality of what a mild recession might look like from your purview, Preston?
Well, first off, I would say, whether we get a recession or not is, especially if it's a mild recession, it's not really that important, because I think we're headed for a growth recession in any case. Even if we don't call it a recession or not, we're headed for a period where growth is below trend, and below trend growth is all that's required to provide deflationary pressure throughout the broad economy. So there's no light switch that is turned on whenever you go into recessionary territory. The fact that the economy will slow down over the next year, and also that will reach into labor markets crucially, which it really hasn't thus far. Labor markets are still expanding fairly rapidly at a robust pace. All of that will help to cool off the broader economy over the next year, whether it happens to be officially declared a recession or not.
Ludovic, do you think it will? What's your outlook at this point on the soft versus hard versus when and what this recession could look like?
I don't think there is such thing as a soft landing. I think this is rhetoric. I think, every tightening cycle ends up in a recession or in a financial crisis historically. So why would this time be different is, I fail to understand some of the observers that think that this time it could be different. I'm sorry. I think I agree with Preston that there is this purgatory of growth for the U.S. The U.S. has not created enough growth. Most of the gains in the U.S. economy are very concentrated to a few stocks, in the financial markets. But for the average people, there is not a lot of growth, right? The only reason why the labor market is resilient is labor hoarding, because a lot of people are waiting for fiscal stimulus. But we are heading to an election year. And remember 2016, remember other years where you have this muddle through, which is not very good for the bottom 10% of the population, the bottom 20% of the population. So for me, recession or no recession, you call it the way you want. It's not good. It's not good because it's going to be the same people that are going to be affected that have already paid the very high price of the cost of living crisis. So I'm a bit concerned, I would say, about the social compact. And that's why it's going to be a litmus test for the Fed and its political independence to be able to maintain rates all through 24, at a high level without pivoting. I think I don't think materially you start seeing a bit some of this deceleration in the very cyclical sectors. And so I do not see why labor markets would defy gravity with this level of interest rate and this, interest burden on agents, households, companies, and also the government.
Gentlemen, really interesting discussion. Thank you very much. Ludovic Subran, who is Allianz Chief Economist, and Preston Caldwell, Morningstar Research Services Chief U.S. Economist. Thanks to you both. All your markets action coming up ahead. You're watching Yahoo Finance.
We're set to commence yet another earnings season, cyclically here, of course, on that rolling quarterly basis. As we think about what the theme could be for this earnings season, what jumps out to you?
I think it's going to be about future guidance. And so the theme, I think we could still see some of that AI, a lot of balance sheet management as well, just given the fact that we are in this higher for longer interest rate environment. But I think this earnings season is particularly important about the future guidance, what going into the second half of the year, because right now, the market's anticipating a decline in Q2 earnings of about 7% year over year. The second half of this year looks a little bit too rosy to us. And so I think it's all going to be about future guidance for the second half.
Welcome back. Let's do a check of the market sponsored by Tasty Trade. We are seeing stocks rise pretty much to the highs of the session here with the Nasdaq up 1.5%. Communication services, the group that is leading the charge today along with information technology, but consumer discretionary is also participating. The S&P up 1% and the Dow up 0.8%. It has been more than 7 months since the Inflation Reduction Act went into effect, and the measure's efforts to expand clean energy initiatives, they're beginning to take hold. Over the next 10 years, the act aims to lower carbon emissions by 40%, creating 9 million new clean energy jobs in the process. That's according to estimates from UMass Amherst. So how effective has the IRA been in these early days? David Calloway is with us now. He's editor and founder of Calloway Climate Insights. Thanks for being here.
Glad to be here, Julie.
So obviously this is a longer term plan. What can we see thus far, and how are we to judge it?
Well, I think we should be really excited about the first 9 months. It's gone much better than expected. It was obviously a very difficult act to get across, right? They had to name it Inflation Reduction to satisfy some on the other side. But that the response has been booming, and it's done some really interesting stuff. Up until about 9-10 months ago, Europe was considered the overwhelming leader in climate action. China, a little bit to some extent, and the US, a distant third. This has propelled us to the top of the list. Everybody wants their own Inflation Reduction Act around the world right now. The subsidies, the ideas, because they're starting to see booming amounts of infrastructure money, government money flowing in, and private money attracting it in infrastructure plays and renewable energy. The results, which really kind of drove home the success of it, hit this week, Julie and Brad. Something called Carbon Monitor, which monitors emissions globally, reported that U.S. Carbon emissions actually fell in the first 4 months of this year, for the first time in the Biden presidency, and really first time since COVID, since we were all in lockdown. That it goes against countries like India and China, where they're still rising precipitously. So it was good news for President Biden as he went to Europe and talked climate with King Charles. And it really shows that the administration's riding high on these investments, which are really just starting. Some people are saying, granted, they're on the Democratic side, they're saying this could be the most important economic act in 30 or 40 years. If it really takes off and we see the shift into renewable energy that we're expected to see from this. So, 9 months in, pretty good. Well, obviously, we'll take a look after a year, 2 years, 3 years. The test will be in 10 years, whether we actually do it. But so far, off to a really good start. And, that's going to translate, I think, to jobs and economic recovery, probably at a pivotal political time for the president.
Well, and if we're looking across a 10-year timeline, it would need to have a certain passing of the baton in terms of prioritization or allocation of that spending, too, over an extended period of time. So even if we look more near term right now and look at some of the benchmarks that would say that this is a success or not, even as we get towards the 2024 general election, is there one key figure that either the president or more broadly Americans can look to say whether or not this has been a success?
Well, I think in any election it comes down to jobs, and so that's going to be the key figure that's derived. Right now, people are kind of looking at level of investments. So for every dollar the federal government puts in, and I think they pledged $380 billion to this in this act. For every dollar they put in, how much private money comes in? And it's flowing in. And it's flowing in from outside of the U.S. as well. So right now, that's it. Now, will that translate to jobs? That's the bet that the Biden team is making. And they're facing a really kind of difficult conundrum because they're essentially betting on a response to climate change, but they don't want to talk about climate change because it's a hot button political issue. So we'll see how it goes. But I think, Brad, jobs is going to be the key. And that's why before the president went to Europe, he was kind of barnstorming around the country, talking it up.
Yeah, I want to switch gears for a minute because and talk about Rivian, because obviously that's one of the other very visible ways that clean energy is being seen in this country is with electric vehicles. So we're watching the shares of Rivian. We've seen a big winning streak for the stock that has sort of come to an end here. It's down about 1.2%. It had been up, fueled by its strong second quarter delivery numbers and maybe also just some enthusiasm about so-called meme names or some of these more meme-ish names. I think Rivian probably falls into that category. But how for you, as you look at the clean energy and EV landscape, how does Rivian fit in?
Well, the EV landscape is a key part of the Inflation Reduction Act and the subsidies. We all now can get subsidies if we buy electric vehicles. There's finally enough models out there where, people can, it's not just Tesla, right? You can buy a Ford, an E-Mustang, and GM is launching a few. Porsche has its own. And then you've got these and kind of what I call the EV startups, the ones that came about in 2020. Some of them were SPACs and stuff like that. Remember those? And they were going to just come and create and take over the auto industry. And they're having a shakeout now because it's maturing. Ford and GM are spending massively. Tesla is making 500,000 cars a quarter. And so you've got these EV startups. You've got kind of Nikola and Lucid. They're kind of on the end of the spectrum that is on life support, so to speak. Then you've got Fisker and stuff, and Rivian is right there in the middle. No one quite knows what to do. And 2 weeks ago, it had these cool production numbers, way above estimates. It shows it's going to, if they keep on them, they'll hit their projection of 50,000 new automobiles this year. I don't know about you, but I'm starting to see them on the roads more.
I still get excited when I see them, I have to say.
Yeah, and they get my attention. I don't see a lot of Lucids and stuff. I see the dealerships, but the Rivians are starting to appear. And so the stock ran for 9 days in a row, 10 days in a row until yesterday, maybe. Maybe it's a little bit overbought at this point. But they're giving their second quarter earnings on August 8th. And I think it's going to stay inflated at least until then, and then we'll see.
I wonder how much is going into marketing dollars right now, too. I mean, I've got a video on my phone from when on the West Side Highway, there was a whole caravan of Rivians that were just daisy-chained one by one as they were doing some activation. So they're spending a lot right now. Just a question of how much of that actively turns.
That's the key. And for them really is the production has to meet the marketing, right? If they do 50,000 vehicles this year, Tesla's going to do 2 million. You have to scale that up, and they're going to need more investment dollars. Sure. Amazon's a big investor. Ford was, and then got backed out. So they're going to need more investment dollars. So over the course of the next, I think, 3 or 4 quarters, Brad, we're going to start to see if they make it or not.
Sure.
Dave, thanks for coming in. Good to see you.
Happy to see you guys.
Dave Calloway, editor and founder of Calloway Climate Insights. And speaking of EVs, there is one EV mover we have to talk about today. That is Lucid. The shares are slumping almost 11% after a reported drop in production and flat deliveries in the second quarter. Concern over demand for its luxury sedan have weighed on those shares. The stock is down about 58% in the last year. And we got all your markets action coming up. Stay tuned.
The jobs market's going to continue to slow, and that's good news, paradoxically. I mean, the Federal Reserve is trying to engineer a soft landing. We're seeing leading indicators for the job markets weaken, which suggests that the job growth in this country is going to moderate.
Inflation continued to cool in June, but not all categories were equally chilled. Yahoo Finance's Rick Newman joins us now to answer the question, where is and where isn't inflation? Rick, tell us.
Hey, good news in the inflation report. I track about 25 or 30 inflation categories on a month-by-month basis just to follow the trends. And one really important thing is that goods inflation stuff is actually declining. We actually, on a year-over-year basis, we're actually now seeing a 1.2% decrease in the price of commodities, which means inflation is actually beginning to reverse itself. That's great news for consumers. One of the things that has kept people in kind of a bad mood is even as the rate of inflation moderates, all those price hikes that have come in during the last 2 years, those are still there. So we've seen disinflation, but now we're actually seeing deflation or dropping prices for goods overall. Services are up 5.7% on a year-over-year basis. Basically, all of the inflation is now in services. And when you break this down by category, which I've done, I think one of the things that's hurting people the most is rent. That's up 8.3% on a year-over-year basis. Groceries, the rate of inflation there has been falling. It's now 4.7% year-over-year. That's pretty high, still pretty high, but it's been coming down a lot. But then if you look at some of these categories where prices are actually declining, appliance prices are down, furniture prices are down, electronics are down, and used vehicles finally have flipped. They're down 5.2% year over year. So we are making progress here, and most economists think these trends are likely to continue. So inflation becoming less of a problem.
And so, Rick, how do you expect the Biden administration to lean into this?
Biden is going to keep saying what he's been saying, which is we are doing a good job getting inflation down, and there's more work to do. Of course, there's not much the Biden administration can actually do about inflation. That's up to the Fed. And we've been talking all week, of course, about whether the Fed's going to raise interest rates again or basically call a permanent pause. The interesting dynamic politically is that Republicans, going into the 2024 election, they think Biden's biggest weakness is inflation. But inflation is dissipating. And of course, we've got like 15 months until the actual 2024 election. By this time next year, inflation might be a non-story. So whoever the Republican presidential candidate is, if he or she thinks that they're really going to hammer Biden on inflation, they might need a backup plan.
Yeah, well, hopefully for all of us, it will have abated without a recession somehow, magically. Rick Newman, thank you so much. Appreciate it.
Bye, guys.
We got much more Yahoo Finance coming your way in just a moment.
Have you tried pickleball yet?
I have. I'm a tennis player. I grew up playing tennis. And so at first I was really hesitant, but at a family mini reunion, they forced me to play. And now I actually think it's pretty fun.
So if you had to pick one now, would it still be tennis?
It would, of course, be tennis. I'm sorry. I'm loyal to tennis, but I understand the insanity around pickleball.
The June CPI report came in this morning, and the Federal Reserve's steps to cool inflation seem to be working. Inflation rose at the slowest rate since March 2021, with the core month-over-month figure rising by 0.2%. So, is this the light at the end of the tunnel that we've been waiting for? Let's bring in White House Council of Economic Advisors Chair Jared Bernstein. Jared, good to speak with you here on Today. Is this the light at the end of the tunnel from your perspective, and how is this being discussed within the walls of the White House?
Well, I think the important thing in that regard is that we've had 12 months in a row of slowing inflation or disinflation. Here at the Council of Economic Advisors, we're very careful not to over torque on 1 month results, whether they go up or down. But when you have a trend like the one you're showing in that figure, that's a pretty reliable pattern. And so the fact that we're now at 3%, that's 2/3 down from inflation's peak a year ago. The fact that we saw the core rate, which is still quite elevated, the fact that we saw the core rate come down 0.5%, that's also welcome news in this regard. So in both those cases, we have kind of the trend is your friend dynamic playing out. That's favorable to American workers, and it's very consistent with a key goal of Bidenomics, which is to provide families with some real breathing room.
Well, and on that front, Jared, hey, it's Julie here. It's great to see you. We know what's been happening on the monetary front, right? What the Federal Reserve has been doing to try to bring down inflation. What can the White House point to specifically that has helped the inflation picture for Americans at this point?
Yeah, that's a great point, because I think if you consider two factors going on in the economy, which I think you were just talking about, the question is nicely answered. We're seeing something that's kind of unusual in the current economy: sharply declining inflation. That is, inflation down 2/3 on a year-over-year basis over the past year. If I were talking to a year ago, we'd be talking about a print that was north of 9%. Today, we're talking about a print that's at 3%. At the same time that unemployment has been below 4% for that whole period. And in fact, we've seen a higher share of working age Americans in the workforce, in jobs now, than in 20 years. So we have slower inflation amidst strong labor market demand. That implies that some improvements, important improvements, have been made on the supply side, unsnarling supply chains. We also see that if we look at goods inflation, which has been softening for a while now, and I think came in flat in June. What was the White House role there? Well, ever since the president took office, he quickly recognized the importance of unsnarling supply chains. And we stood up something called the Supply Chain Disruption Task Force. We got to work at the ports on the West Coast. This is all stuff that took place a while ago. But I think that unsnarling of supply chains, which does have Joe Biden's fingerprints on it, in tandem, very much so with the work of the private sector, is playing out in this and some of the prior reports.
We've continued to have discussions with some economists who have kind of pointed towards a period of profit-led inflation that certainly is something the White House has been looking at across where corporations are netting out profits. And even over this time, how are you continuing to engage companies, have conversations, knowing that the consumers are still trying to make sure that their paychecks hold up to higher prices, while at the same time knowing that corporations have a job in this too?
Well, the third tier of Bidenomics. So Bidenomics has three tiers. One is smart public investment to pull in private investment. We see that in play. The second is empowering workers through a tight job market and worker training. That's also in play, part of the CHIPS Act. The third is promoting more competition, both to lower prices and to give small businesses a fair shake. So bringing down some of the anti-competitive barriers that have grown up over the past few decades is an important component of this. And at the end of the day, that should help put some downward pressure on margins, especially when industries are anti-competitive. That involves everything from getting rid of junk fees, from taking down overdraft fees, which the president has done through administrative rule changes. That, by the way, saves families over $5 billion a year. And of course, it includes the role of the independent FTC, which is, I think, working aggressively to restore fair competition to our corporate sector. So I think all of those play a role. I do think that when the job market remains as tight as it's been, workers have more bargaining power. And one of the things we really like in today's numbers is we're seeing, as inflation's been coming down, wages have been going up. So we now have real wage gains to the tune of 1.6% over the past year for middle wage workers. That's really an important improvement in their buying power.
Yeah, definitely that is good news for people. So when all is said and done, what do you think are the current odds that the U.S. economy will avoid a recession, and if not avoid it, that it could be mild?
Well, because of where I sit here at the White House, and I'm not a talking head at a market shop or something, we don't get into those kinds of probabilities. I do certainly track all the market shops, and I think many of them have rejiggered those probabilities to a more of a soft landing scenario. What I would say is the following. I found it very useful here, especially here at CEA, where we advise the president and the senior staff on the economy, to explain things that we can see in real time. And here, the indicators are just flashing steady, stable growth. If you look at the job market, if you look at consumer spending, if you look at this trend in inflation that we've been discussing, 12 months of decelerating yearly inflation, some real wage gains, which, by the way, will come in and help support consumers broadly. That's, by the way, important as some of the excess savings in the systems burn off. So I think if you look at the indicators as they stand, you'll see numbers that are consistent with a growing economy. And in fact, that is what the GDP numbers themselves show. So in that sense, I very much like where we are.
White House Council of Economic Advisors Chair Jared Bernstein. Jared, thanks for the time. All right, everyone, all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Not enough people are focusing on the fact that things are getting significantly better than where they were with regards to inflation and with regards to policy tightening. Inflation is actually going to be very close to the central bank's comfort level fairly soon. And that's a far cry from where we were a year ago. And that sets the stage for the Fed to end the tightening cycle, which typically creates nice conditions for markets over the subsequent years.
Welcome back. We're watching shares of NVIDIA today after the Financial Times reported British chip designer ARM is planning to bring the tech giant as an anchor investor ahead of its IPO. NVIDIA declined a Yahoo Finance request for comment. Yahoo Finance's Dan Halley joins us with the details here. All right, so help us flesh this one out a little bit more, Dan.
Yeah, that's right, Brad. You might remember a while back, NVIDIA wanted to actually purchase ARM, but there was a whole bunch of pushback from ARM customers as well as an FTC lawsuit, and so they kind of just backed away from that. And so now this is a chance for them to essentially get in on the ground floor of an IPO in New York. And to kind of have a say over where, not a say, but a position at the table when it comes to ARM. Now, just to put this all in perspective and what ARM means, they're basically in every smartphone you can think of. Their designs are used by companies ranging from Apple to Samsung. As far as smartphone makers go, those companies then kind of reconfigure the designs to be their own. They're also in smartwatches. We're seeing them in more devices. They're going towards more PCs. Increasingly, there's discussion of whether or not this is kind of an AI kind of company. It's not going to be an NVIDIA as far as that goes. But why NVIDIA is interested or was interested in ARM is because they need CPUs. They do put out a CPU-GPU combo product, but NVIDIA is all about GPUs. GPUs drive AI, but to power those GPUs, you also need CPUs. NVIDIA getting a seat at the table when it comes to ARM as a public company would be important, just because it would allow them to see what's going on as far as CPUs go and then be able to plan accordingly. So this could be a big move for them. But as you said, they declined to comment. So we can't really go much further as far as speculating goes, just because they won't tell us what they want.
I mean, it's really interesting, though, too, because reportedly, according to that Financial Times report, the valuation at which NVIDIA would invest would be much lower than the valuation that SoftBank wants for ARM, right? So that's, I guess, says something about the market appetite as well.
Yeah, and Masayoshi-san cannot be happy about that. That's SoftBank's investment fund had, taken a beating as far as the bunch of startups that they had invested in, and so this, kind of is seen as a way to win some of those billions back. But yeah, not coming in near where they want. The valuation for ARM is kind of all over the place at this point by billions of dollars. So it's not exactly, a definitive, we know how much this is going to go out for. But yeah, I do think that it's been an important company for the tech industry for so long. Most people don't know what ARM is, though. They know what a company like TSMC is. They know what a company, well, maybe they do. They know what Intel is, that's for sure, and they know what NVIDIA is and AMD. But, ARM really is an incredibly important company when it comes to the tech industry. It cannot be overstated how important this company is. And so seeing NVIDIA potentially latch onto, according to this report, to the IPO would be really interesting to see.
Yes, it would. Speaking of very important for the tech industry, Microsoft got a big win in court yesterday, of course, with basically a judge saying that it is not going to accept the FTC's request to block that acquisition. What's sort of the read-through here? We have seen so much commentary here about what this means for the bigger landscape as well.
Okay, so just, it's a confusing kind of issue here. The judge was basically stopping the FTC from trying to block Microsoft from closing the acquisition on July 18th. If they didn't meet that deadline, they would have to pay a $3 billion breakup fee or renegotiate the deal with Activision Blizzard. It doesn't necessarily mean, though, that the FTC is giving up on its antitrust suit against Microsoft and the deal. So it's not exactly finalized in the U.S. yet, but most experts are saying, look, they lost here. Chances are they're probably not going to be able to win as far as stopping the deal overall. So that aside, Microsoft and Activision still have to continue negotiating with the UK and their antitrust enforcer, their markets competition agency, and kind of figure out how they can make the deal happen there. If it does, what does this mean for Microsoft and the broader gaming landscape? It's a huge win for Microsoft. They would have one of the largest developers for gaming out there with one of the largest games, Call of Duty. That's a huge win for them on the console front as well as the PC front. the bigger news and kind of the future news is the mobile gaming side of things. Don't forget, Activision Blizzard also has King, which has Candy Crush and all those other different mobile games that make tons of cash. Microsoft doesn't really have much, although if you ask my wife, they certainly do. And the fact that I play the very old solitaire game on my iPhone, which is from Microsoft, but I digress. They don't have very much as far as mobile gaming goes. Then there's also the cloud gaming side of things. That would also be a huge boon for them. They would be able to put these kind of Activision Blizzard properties on their Game Pass service. And then as the cloud gaming starts to pick up, they could put them on more mobile devices. So it's a mobile play, and it'll definitely play out both ways.
I'm a minesweeper girl myself. Thanks so much, Dan. Appreciate it. Thanks so much. Coming up, Brad is going to stick around. Rochelle Akufos got you covered on Capitol Hill. All three major averages are in the green.
LFG. Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Brad Smith in New York, alongside Rochelle Akufo on Capitol Hill. Here is what we're watching this morning. Inflation showed further signs of cooling in June, rising at the slowest annual rate since March 2021. But what does this mean for the state of the U.S. economy? And crypto crackdown. We'll speak with the two senators leading the charge on an ambitious new bill focused on the digital asset. Plus, why investors are eating up shares of the latest restaurant chain to enter the public market. We'll speak with the co-CEOs from Gen Restaurant Group later this hour. But first, let's take a look at the U.S. major averages here. You're taking a look at the Dow, the S&P 500, and the Nasdaq lined up like a burger right there on your screen. The Dow right now higher by about 0.8%. S&P 500, you're seeing that up by about 1% right now. And the Nasdaq composite higher by roughly 1.25%, 169 points to the upside right now. Let's also check in on the Treasury market just very briefly here. We're seeing yields down across the board. The deepest of the decliners that you're seeing there on your screen, the 5-year yield, that's lower by more than 3% today. 10-year yield also reacting to today's CPI print, that down by more than 2%, 30-year lower by about 0.5%. And Rochelle joins us from the Capitol this morning. Rochelle, what are you seeing? What are you hearing? It is echoey out there.
That's right. It's a busy day on Capitol Hill. Of course, we had that CPI print come out. A lot of people wondering, is this going to be enough for the Fed to change its trajectory? We'll have to wait and see. Obviously, you have a very data-dependent Fed. I'm going to have a guest coming up on that shortly. And also what could be a landmark regulatory framework when it comes to cryptocurrencies. I'll be talking to Senators Gillibrand and Lummis, who co-authored this legislation. In a rare bipartisanship push here, we'll see how many senators we can get on board with this. And of course, to see what happens with crypto, as they're really waiting to see what happens as you get more institutional investors trying to get in, and everyone really looking for answers as to how crypto is defined as an asset or a security. So we'll have those answers coming up. But first, of course, we're going to start on that CPI print. Joining me now, we have our guest, Joseph Ceballos-Roig. He's Semaphor's domestic policy and politics reporter. Thank you for joining me this morning. So how surprised were you by this latest print?
I wouldn't say that I was terribly surprised. I think a lot of analysts were expecting just like a very, very good print. And there is a lot of good news in this report. I mean, it shows that inflation has cooled to its lowest level since March 2021. The headline reading was 3%. That's the lowest level since the pandemic started receding 2 years ago. And there's a lot of other good news to take away here for consumers and the Fed as well. Food prices are continuing to fall. The rent prices is also starting to kind of come down, and it's starting to kind of demonstrate that the Fed's early campaign to rein in inflation is actually showing some signs of success without causing a recession.
And what about some of the stickier parts? Obviously, we're also looking at core CPI as well, which the Fed does focus on. But what about some of the stickiest parts? Are we seeing those starting to cool down at a more meaningful rate?
Yeah, I think that housing, rent and shelter is like among the stickiest levels, and the fear is that rents will continue increasing to just eat up more of people's budgets. But they're actually, for future prints, analysts have been saying that there's actually causes for optimism, just as rent increases are just not increasing as much as they used to. It's just starting to cool. So I think that bodes well for future prints when it comes to just reading the tea leaves for inflation.
And it's an interesting situation that we're in, especially when you look at the still very tight labor markets, barely seeing some softness there. What sort of position does this put the Fed in there, where they are seeing this still historically low unemployment and inflation still starting to come down? How much justification do they have for either pausing or even taking maybe one rate off the table at this point?
I think you could start making the case that this print was pretty good, and that you can even make the case for another pause at the next meeting later this month. But when you read the minutes of the last monetary policy meeting, there were members that still wanted to keep raising rates and not go ahead with the pause that they did last month. So I think that more likely than not, we are still going to see the Fed just increase rates. But given that they have been raising rates and the labor market hasn't been really damaged by it, I just think that the Fed is just going to continue raising rates. But you're starting to see officials say that the campaign to raise rates, the most aggressive campaign they waged in 20 years, it's starting to reach its end.
Now, we know that when we get these sorts of prints and the better news, everyone wants to take their victory lap here. How much credit should go to the Fed versus, say, President Biden and his Bidenomics, or just some of the stresses from, say, the banking fallout also playing into this?
Yeah, so that is an interesting question that I think that so many people on Capitol Hill are going to wrestle with. President Biden has recently tried to tout his economic agenda as, Bidenomics, which basically consists of targeted investments in manufacturing, clean energy, and infrastructure. And these are all investments that are designed to help grow the middle class. But, historically, it's the Fed that has a principal role in combating inflation. But, I think you're going to see Biden administration officials and the president himself fanning out across the country this summer to make the case that, cooling prices and then wage gains that we've actually started to see at the bottom end of the income spectrum are the result of Democratic policies, particularly the stimulus, which, you could start making the case that pretty much put the economy in a pretty solid position that it is now, along with some of the Fed's concerted efforts to raise rates.
And you do have to wonder about this recession. Apparently at this point, one of the most well-telegraphed recessions that still hasn't really happened yet. But as we talk about wage growth increasing, you also have employers trying to then have to pay more to hold on to some of these employees. How does that factor into perhaps how long of a recession we might have or where we might be headed at this point?
So that's another interesting part of this debate is that, you're starting to see major banks on Wall Street start to kind of temper their expectations for a recession, given that the economy is in such a really good place right now. But that recession that many Republicans in particular have been warning about has not shown up. And from this print, there really is no sign of a recession in the distance. I think Fed officials are still kind of expecting something to happen maybe the tail end of this year or even early next year as Biden's re-election campaign really gets underway. But when it comes to the recession that everyone's been expecting, it's really just not on the data right now.
And even though things are improving with the economy and also with inflation, it doesn't seem to be moving the needle much in terms of approval ratings for President Biden. What do you think is the disconnect between perhaps how people are feeling, the vibe they're getting about perhaps not feeling like they're doing as well economically, and that message just not translating when it comes to President Biden's popularity?
Yeah, that's another interesting point. That's another thing that I think that we're all going to be paying attention to. Another really good thing that people notice in this report is that wage growth actually outpaced inflation significantly for the first time since early 2021. So, if that kind of reading keeps hold and Americans start noticing a bump in their paychecks, which allows them to spend more, then you might start seeing them feel better about, the state of the economy. But right now, people are still struggling with rising prices basically everywhere they turn. But I think that's going to be another interesting element to keep an eye on is, wage growth for American workers.
I'll certainly be keeping track of that. I do appreciate you joining me with your insights there. Joseph Zabayo-Rowi, thank you so much. Semaphore domestic policy and politics reporter. Thank you so much.
Thanks for having me on, Rochelle.
All right, stay with us here on Yahoo Finance. Much more just ahead.
So we have to know, is the worst of inflation behind us?
I think the worst of inflation is behind us. We see inflation coming down at the end of this year to about 3.5%, with some potential to then get down to about 2.5% by the end of 2024. The thing is that journey from 3.5 to 2.5 to 2 is going to be a complicated journey, but I think what the market is really looking for is signs of that abating, and particularly within the services sector. So if we start to see more deceleration in inflation in the services sector, then I think that'll be enough for the market to really feel and see the end.
Let's do a quick check of the market, sponsored by Tasty Trade. Taking a look at the Dow, the S&P 500, and the Nasdaq. We're in positive territory across the board right now. As we're taking a look at the Dow, that's up by about 0.8%. S&P 500 also higher on the day by about 1%. We'll round that off too. And the Nasdaq Composite also seeing gains of 1.25%. Our own Rochelle Akufo is at the Capitol, Washington, D.C. Rochelle, you've got a range of interviews taking place here on the day, the same day where we got some economic data that came through. Which should we be staying tuned for?
Well, I did think it was interesting when I spoke to Joseph Zeballos-Roig just recently. He was talking about the potential for a pause after, given these good numbers after this July hike for the Federal Reserve. So something to consider, that obviously with a data-dependent Fed, everything is not certain at this point, so we're sort of taking that as it comes. And then later on, I'm going to be speaking to Senators Gillibrand and Lummis about all things crypto, digital assets, some specific changes in the wording as they revise their legislation here, which really takes things from the purview of from the SEC to the CFTC. So we'll be breaking a lot of that down and finding out what that means for exchanges, for investors, and what that means potentially for innovation with crypto and blockchain if overseas starts looking like a less restrictive option to start trading and launching your exchanges, Brad.
All right, looking forward to those conversations for sure, Rochelle, and our viewers can stay tuned for that coming up very soon here. The first half of the year, though, closed out on a strong note for ETFs. Overall inflows for U.S.-listed ETFs, which includes funds tied to stocks, bonds, and commodities, reached $200.6 billion at the end of June. That's compared to the $298.7 billion seen from the year prior. As part of this week's ETF report brought to you by Invesco QQQ, let's bring in Ben Slavin, who is the BNY Mellon Global Head of ETFs Asset Servicing. Great to have you here with us this morning, Ben. So what are the most promising ETFs that you see for the second half of the year?
Well, first of all, that stat is incredible to see, given where we were at earlier this year, considering investors' preference for cash. So off the market low in October, since the S&P has rallied, we saw around $900 billion flow into money market funds. And as that statistic shows, it's quickly reversed. We saw 73 billion come into the ETF industry in just the last couple weeks. And so you can see how quickly we're making up ground, and investors are starting to tilt their portfolio back towards equities. But certainly the flows would dictate that it's been pretty selective in terms of where investors are looking to put that cash.
What are some of the more pronounced themes that you've seen investors really start to gravitate towards?
Well, again, it's been kind of a mixed picture, but let's sort of, break it down in a few different areas. Certainly fixed income has been one area where investors have been looking. Not a shocker to see that fixed income had led equities in terms of ETF flow this year. But again, given what's happened the last couple of weeks, it's reversing. But there are selective opportunities, such as, emerging market bonds is an interesting place to look at, and started to see some investor appetite come back into that market, given the performance. We've seen that lead the pack in terms of fixed income, in terms of performance this year. So there are several different ETFs that track those markets. Also, areas like convertible bonds as well has also been a top performer this year. Again, it's been roughly, dormant for quite some time, and now we're starting to see signs of life. Other areas, certainly in small caps, again, more of a recent phenomenon where we've started to see that category come back to life. And products like iShares IWM, which tracks the Russell 2000, has started to see investor interest, and also that's looking, as it's been starting to outperform really the last few weeks, but certainly been a laggard since we've seen this market rally off the bottom.
Several years back, all of the talk was about how millennials were really embracing ETFs. Has the kind of makeup of investors that have tried to, or at least put more attention towards ETFs, has that shifted at all? And if so, where?
Without a doubt. There is no question that there is a shift going on, and certainly the data will bear that out. We have seen money come continually out of mutual funds. Last year was an extreme outlier, but it's certainly a trend that we've seen, which was a $1.5 trillion swing out of mutual funds into ETFs. And, there are several reasons for this. I mean, certainly the liquidity, the fact they're low cost, the tax efficiency is all driving that. But if you look at market surveys, you talk to advisors and even talk to many of our clients at BNY Mellon, there is a different shift in how these products are marketed, and the appetite towards the younger generation, as we're seeing this wealth transfer begin to take place, has really benefited the ETFs. And there doesn't seem to be anything at the moment that would indicate that trend is going to slow anytime soon.
We had seen some type of interest towards ETFs that were even tracking SPACs. The SPAC bubble has clearly burst here. I think it's fair to say, or at least it's deteriorated substantially. Has there been, of course, where there are inflows into some ETFs, outflows, I guess, on the other side, perhaps worth part of this conversation as well? And if not SPACs, anywhere else where you're seeing significant outflows?
Yeah, actually, there was a SPAC and a de-SPAC ETF. So, typically with ETFs, you get both sides of that trade. But what I would say is these thematic ETFs, quote unquote, which are quite popular in the ETF market. And we've seen several, indications that, again, this trend will continue. More recently, we've seen, for example, AI and AI-themed ETFs obviously catch investor attention. Now, the hype cycle has been off the charts for AI, but ETFs, again, offer a quick, low-cost, easy way to access this theme by investors. And, it's another great example of, ETFs providing that toolkit to provide this type of access. So, maybe 18 months ago it was SPACs. Now it's AI, and certainly there's a wide variety of options out there for investors to tap into as these themes continue to develop.
Yeah, one of the subsets even within AI, as I've been tracking it over years, is the ETFs like cyber or hack that are more cybersecurity focused, but have AI elements that are also infused into many of those businesses too. Are there different areas, even as subsets of AI, where you've seen people or investors kind of pick and choose where they kind of want to lean more into the language learning models, or lean into the chips part of AI, or lean into the applications part? And if so, where's that? Certainly, I mean, I imagine that it's been in chips, but where have you seen that from your side kind of catch even more fire at this point?
Yeah, this is a question near and dear to my heart. And I think it's a great example of investors and advisors really knowing how to do their homework in the ETF market. There are lots of products that are out there, and also some variants of these themes, like you mentioned, hack and cyber, certainly AI-themed ETFs. There's also robotics and other automation-themed and technology-themed ETFs. So it's very important for investors to look under the hood and know what you own. And one of the great sort of attributes of ETFs is that information's all available, and it's available on a real-time basis. So whether you have a place to get your financial market data that or just looking at the investors' websites, that is a way to access what is in these funds and be able to suss out how you want to position those portfolios and understand the weightings and really what's contained. It's more than just the name.
Ben, thanks so much for joining us this morning and helping break this down, especially as we are now in Q3 and the second half of this year. Looking forward to what more ETFs will bring in terms of some of those inflows. BNY Mellon, Global Head of ETFs and Asset Servicing, joining us here this morning. Thanks so much, Ben.
Thanks a lot.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Have you tried Threads yet?
I have not. No, I have not. I hear good things though, so I'll leave it at that.
Okay, it's early days. I know I was in the tens of millions that first signed up for it, so I guess that's all I have going for me right now.
Well, if you're an active user, then you can coach me on it.
Okay, I will report back on that. Welcome back to Yahoo Finance. Brad Smith in New York alongside Rochelle Akufo at the Capitol. Rochelle, you're standing by for some big guests over there.
That's right. I'll have Senators Lummis and Gillibrand coming up talking about the Responsible Financial Innovation Act, or the RFIA. Now, that's going to be laying out the regulatory framework for digital assets and digital asset exchanges. So that's something that we know that there's been a lot of concern over who should be the governing body that regulates crypto. And the SEC has really taken the stronger hand in this and has been really at the forefront of most of the action that we've seen against exchanges as well as individual platforms. So it's interesting to see this shift then to have more of the purview come under the CFTC. So I'll be asking the senators why they made that move and why they do consider crypto assets and really the ramifications for that if you are an investor, if you are a consumer, and the sort of protections that also come along with that. So lots of exciting stuff here. I'll be looking forward to getting into that with you later.
All right, that conversation is a brewing and sure to be spicy as well. Thanks so much, Rochelle. We're going to be standing by for that. In the meantime, the weather's hot, but the deals are hotter. We're in the second day of the Amazon Prime Day craze. Yahoo Finance's Shauna Smith and Akiko Fujita spoke yesterday with Jerry Storch, the former vice chairman of Target and former CEO of Toys R Us, about what to expect from consumers.
What do you think we'll learn from the deals and from the buying activity that we're seeing during Prime Day and also at some of Amazon's biggest competitors over the next couple of days?
So I think the event will be successful. Amazon is throwing everything at it. They need to show they can generate more growth than what they've shown in the past. So the past few Prime events, just like Amazon sales quarter after quarter, have just been up a little bit, not enough or not consistent with their path growth trajectory. So they're advertising heavily on TV. They're throwing a lot of deals at this thing. They're advertising deals by their partners. They're pushing this very hard to make sure it's successful. I believe it will be successful. And so that means if they sold $12 billion, counting their partner sales last year, maybe it'll be up, to 14 or $15 billion this year, which is pretty darn good over the 2 days. Putting that in perspective, that means in those 2 days they'd sell as much in total as maybe, Nordstrom or Kohl's or someone sells their entire business for the whole year. So that sounds great. What we don't know is whether they're just pulling sales forward from later in the year or whether this will be kind of the last gasp of a beleaguered consumer.
Yeah, I mean, that's a good point. When you think about where we are in the year, the offerings themselves from Amazon, they're sort of the usual discounts that you talked about, but also this year they've added travel and partnerships on that front to add to the discounts for Prime Day at a time when we have seen consumers really shell out money on that end, even though they're saving on some of the more discretionary items too. I wonder how you're looking at that balance, the priorities that are shifting right now for the average consumer.
No doubt whatsoever, consumers have been shifting from buying things to services. And you hear that, all the time, from every source. That's true. That is happening. And in fact, when you look at retail sales and take out restaurants for the last 10 straight months, that year-over-year growth has actually been negative when you strip out inflation. So they're not buying things. Now, you often hear they're buying services, and we hear the great stories of how airlines are doing so well, or hotels, for example, or restaurants. And those are up. We are seeing growth there, but it's starting to slow down. Where the real growth in services, when you look at the numbers, is in healthcare services and in paying for rent, which is included in services when you look at a lot of the government reports. So sometimes I think the story isn't being told correctly when they keep saying, oh, the consumer is still spending. Well, you got to pay for healthcare and you got to pay for rent. A lot of healthcare was pent-up demand from the pandemic. There are these categories still. They're not big enough, though, to really, shift the entire economy or consumer spending of travel and dining out. Those are still up. But I think we need to watch them very carefully because you're hearing stories now like occupancy rates in hotels in Florida are down year over year. You're getting these little snippets that don't quite sound as good as they were before.
Well, then, Jerry, given all that, the importance of discounting, of this promotional activity, are we going to see even more of that over the next several months heading into the holidays, given the fact that people don't have that much extra money to spend on some of these discretionary items?
Well, retailers worked very hard to get their inventories down. As you know, many got bloated inventories, at the end of the pandemic when they panic bought, thinking that suppliers wouldn't ship, and then suddenly all the suppliers shipped at once, and inventories surged, and you had retailers that were up, 50% year over year, that kind of number, crazy numbers of inventory, and they worked hard to get those down. So I know people are still trying to be careful, but I don't believe that most retailers have processed just how weak this holiday season could be. Again, I don't know that it will be. It just could be weak. And if the holiday season is weak, we're going to be back in that same thick soup of too much inventory. And the only way through that is going to be through a lot of markdowns, as you mentioned. So I expect to be very tough sledding for a while here. Consumer debt has been mounting. Delinquencies have been rising. I know everyone says, oh, the consumer is still spending. I don't know what they're talking about. Again, keep in mind a lot of these money there, the growth is due to inflation. And then when you strip out some of the necessity services I mentioned, it doesn't look that good all in all.
And that was Jerry Storch, former vice chairman of Target and former CEO of Toys R Us. Let's get back to Capitol Hill, where Rochelle Akufo is standing by. Rochelle.
Thank you, Brad. So yes, I'm live here on Capitol Hill with two senators here. We have Senator Cynthia Lummis from Wyoming and Senator Kirsten Gillibrand here from New York. A big welcome to you both here. A very big day here, an important piece of legislation here. So talk about the RFIA and some of the changes that you made. Senator Lummis, I'll start with you.
Go ahead. She's Senator Lummis.
Oh,
yep.
We first introduced the bill last year and then began to educate our colleagues about our approach, which is to have a bill that would create a regulatory framework that's very similar to other assets, but that would do so in a way that would foster innovation. Then we had FTX and other business failures surrounding digital assets that really set people back, and they were concerned about moving forward without assurance that we had doubled down on consumer protection. So that's what this bill does. The consumer protection provision is twice as long as it was under the original bill. We're reintroducing it today, and we'll once again have the opportunity to create a regulatory framework that will protect consumers, but also allow for innovation in this space.
And Senator Gillibrand, I know that there was this concern over how these things are defined as digital assets versus securities. And it does seem from the wording in the bill here that it mostly comes under the purview of the CFTC as assets. Why that decision?
That's not what the bill says, actually, and I think it's a misinformation created by people who want the bill to fail. In fact, what the bill does is looks at digital assets and defines them by their characteristics. So a digital asset that has the characteristics of a security as defined by the Howey test, which is the legal standard, if it meets the Howey test, then it's a digital security. If it does not, and it is fully decentralized and has the hallmarks of a commodity, then it's a digital commodity. And so we're very clear that assets that are being offered to raise money, like a stock is for a centralized company, that's going to be a digital security because it qualifies and satisfies the Howey test. There's over 15,000 cryptocurrencies right now. Most of them, the vast majority of them, are going to be considered to be digital securities. So the workload by the SEC and CFTC will both be enormous. The one digital asset that has largely been considered to be a commodity by almost all experts is Bitcoin. And so Bitcoin regulatory framework will be under the CFTC because it is defined as a digital commodity. Other than that, there's no clarity about which others will satisfy. They'll have to go through the focus of the legislation that allows for any digital asset to be considered based on its hallmarks, based on its characteristics, so that it will have the appropriate regulator. We've also created a authority that is staffed by people from both the CFTC, the SEC, from the OCC, from Treasury, that will look at these newer types of digital assets that don't clearly fall under a digital commodity or a digital security, and will make recommendations of those. So we've really thought through a lot of the challenges of the industry overall. And this is a year later. So we've seen the rise and fall, we've seen different collapses, and as Cynthia Lummis said, we've really focused on consumer protection. Not only did our consumer protection provisions double in size, we now have pages of Know Your Customer and anti-money laundering provisions that's based on some good bipartisan work by other senators. And so We are collaborating with many people within the Senate who are focused on this issue. We've also taken the time to collaborate with the SEC. We've met with their staff, we've taken their comments, we've made changes to the bill based on their feedback, as well as the staff at the CFTC. So we feel very positive about the direction this bill has gone in, and we think it really addresses and meets the need of today and meets the moment of today.
And do we think it's going to pass as is, or how much bipartisan support do you have for this at the moment?
We've been meeting with members of both parties for months, and now that we have the final language for people to review, we'll be able to add to our bill a number of co-sponsors in both parties.
And as you mentioned there, consumer protection, obviously very important. That's one of the main things that was highlighted by the collapse of FTX. For people who are saying perhaps some protections for some of these exchanges, should there be something more similar as we saw with some of the banking protections? Could we see those sorts of protections for exchanges, and how far will they go?
Many of those banking protections are in the bill. So know your customer, anti-money laundering, those are banking terms of art. And so we've really looked at what are the safety procedures for banks to make sure that they are replicated where appropriate throughout the entire industry.
And for people who are wondering, with the tighter regulations, could we risk seeing innovations in blockchain and crypto go overseas because regulations are too tight? What would you tell them?
Right now, I'm more worried about people going overseas because Europe has a regulatory framework and we don't. We're hearing companies say that they've been impacted by enforcement actions when they've tried to reach out to the regulatory agencies and asking them, what do you want us to comply with so we can avoid getting tripped up by enforcement actions? And these businesses have felt that they haven't gotten adequate guidance from the regulators. So they're looking overseas now because of the regulatory framework in the European Union that is more is farther along, is more mature than what we're doing here. So we need to move forward to protect this industry from leaving the United States.
Without a regulatory framework, there are no consumer protections. There's nothing to protect U.S.-based consumers and U.S.-based businesses. And what I've heard from a lot of the New York businesses is that they have sought regulation, they have sought to register, they want to be broker-dealers, and they've been ignored by our regulatory agencies who, because there's no legislation, don't have the framework from us as to how they should regulate. And that's really created enormous challenges that cannot be overcome. So a lot of those really strong New York businesses and national businesses are going to go abroad because they have consumer protections, they have certainty. And uncertainty is one of the biggest enemies of any business because you cannot innovate, you cannot offer products to customers, you cannot really have a going concern if you don't have rules of the road.
And in cases where a more opaque or very non-transparent company is operating offshore now, we want to include it in our framework, registration with the CFTC. So if a company like Binance, for example, wants to do business with customers in the U.S., they're going to have to register with the SEC and, with the CFTC. And then if they create ancillary organizations, they're going to have to be transparent about that as well.
And in terms of reaction, I know that some of the key stakeholders, you have the SEC, the CFTC. What about within the crypto industry themselves? What role did they play in shaping this legislation?
Well, both Cynthia and I have met with businesses across the country about what's your business model, what are you trying to do, what are you offering to customers, what consumer protections do you have? And so we actually spent a lot of time just learning the industry in all its many, many forms. And this bill largely focuses on cryptocurrencies and blockchain and digital assets that are used in finance specifically. And that's why a lot of the banking regulations apply. It's why this consumer protection aspects are so important. But there's a whole nother world of digital assets and applications for blockchain that this bill doesn't even yet address. So there's a long way to go. But this is the stuff that needs to be done now. There's a sense of urgency because of things like FTX's collapse. FTX was registered in the Bahamas. That was intentional. They didn't even try to register in the United States. And what they did would be illegal under U.S. laws. What we do in this legislation is clarify that it is all illegal under U.S. laws, and this is the way the law is written. So we have looked at all the challenges that we've seen. Another challenge we saw was with the collapse of a stablecoin. And so we have focused on what is a stablecoin. Stablecoins should actually be stable, and they should be 100% fiat backed. So we have strict requirements about who can offer stablecoins and what it looks like in this legislation, which is also something that has a sense of urgency because of that past collapse. It does not allow for algorithmic stablecoins, which we think is a great place to start. And if in the future there's space and room for different types of products, these regulatory agencies can then look at that, review it, and make recommendations. But in the meantime, let's at least create basic rules of the road so that we can have US-based participants and US-based customers that aren't taken advantage of.
And that's certainly all everyone wants, clarity. So hopefully you'll get this, and hopefully you'll get the support that you need for this. Thank you so much for joining us, Senators Lummis, Angela, Brad. Thank you for joining us here on Yahoo Finance.
Thank you.
All right, stay with us here on Yahoo Finance. Much more just ahead.
Actually, Rochelle, I'll take it on over from here. Let's get straight down to our own Brooke De Palma. She's at the Nasdaq right now, standing by with a special guest. Hey, Brooke.
Good morning, Brad. That's right. I'm here with Gen Restaurant Group co-CEOs and co-founders, David Kim and Jay Chang. Good morning to you both. Thanks so much for being here. I mean, what an IPO debut. You raised $43.2 million. That was double your expectation there. Cava also had a similar debut on the New York Stock Exchange recently. What sort of excitement do you think investors have right now for this next generation of restaurant groups? David, let's start with you.
So, our belief is that there are new trends of brands that are growing in this country. It used to be where it's the steak and potato, but now with so much social media coverage on different types of food that's out there in the market, and the consumers are now getting more attracted to other types of food. So that's why, we at Gen, we do very well. Cava, it's a very different type of food out there. So I think the whole trend of where the consumers are going with their taste, especially the younger generation, is moving to the non-traditional food of the industry.
And David, are you at all worried that there are too high of expectations right now for the company?
Yeah, we as a company, when we went public, we actually make a profit, okay? We see a lot of companies that go public and try to get out of or go towards to a profit stage. So we're a very profitable company. Getting too much expectation, high expectation of growth, when you grow done this before, got to be very careful how you grow this, because you need your staff, your human capital to support it. You can't just grow and open a lot of restaurants and they fail. So we're being very careful in how we approach this growth.
And Jay, let's talk about this unique business model that you have. It's a cook-it-yourself type of business model. And the CPI report came out today. Food prices and inflation overall starting to moderate. Are you seeing any food prices or any ingredients continue to cost higher for the company? And how is that impacting you ultimately?
We've been very blessed where we've been able to control our food cost. We have 30 plus different cuts of meat. It's a combination of chicken, beef, seafood. And it's an experience where customers could actually cook their own food. If you burn it, I'm sorry, but we'll give you more. We'll give you more, a lot more. So it's one of those interactive concept where the younger generation just loves it. It's a family style. And once again, the concept has been there for a very, very long time, 40 years plus. We just mainstreamed it. We just wanted to make sure everybody has a chance to understand what Korean barbecue is.
And you continue to push forward. You have plans to ultimately open 250 locations long term. Is that where you're still seeing your growth plans, or do you have plans for even more now after seeing the run up of this IPO, David?
So, when we first looked at the whole market in the US, it was about that number, but we tested some smaller markets and they're actually doing extremely well for us. So the numbers are going to change to a much larger number in terms of our growth plan, but we're still gathering more information, understanding how our restaurants behave in a smaller market.
Yeah, and speaking of that store format, it's quite unique. You guys have your own ventilation system. Break down how ultimately that helps save costs and ultimately helps you grow at a faster rate. Maybe Jay, if you want to take it away.
Well, we do have an internal building company so that all the hood system, we do it in-house. We have a lot of, like a level system where everything comes in and it's all leveled in. So it helps us to bring our costs down when we're building our restaurants, and also it's faster means.
And in addition to that, I mean, what a moment for you two. You guys are both Korean immigrants. You both came here to the US with the American dream. David, Jay, for both of you really, what does this moment mean for you, and what sort of message do you want to send to other entrepreneurs? David first.
Yes, we are immigrants, okay? When our parents came to the country, they really didn't have anything. And what I see in young people these days, some despair, or maybe they're running into walls of maybe the system, the United States system is not working for them, but it's working, it's alive. And we're true believers that not just working hard, but actually staying focused and working with the staff that believe in what you do. And the definition of America, right? This is the land of opportunity. And we're in 2023, and it is still the land of opportunity compared to any other country in the world. Okay, so we are not just believers, we live that. And we're so appreciative of this country that has provided for people like us who started out as dishwashers, okay? And we able to reach here plus doing more. So no. Whoever is watching this, American dream is still alive. Okay, it will continue to be alive. The innovations and the spirit, and I just want to let the people know, especially this is a hard business. The guys who are starting this business, this is not give up. Don't give up in this thing. Okay.
Right.
Because there's so many opportunities, so many things that you can do.
So inspiring. David Kim, Jay Chang, co-founders and co-CEOs of Gen Restaurant Group. Stay tuned for more on Yahoo Finance.
The jobs market's going to continue to slow, and that's good news, paradoxically. I mean, the Federal Reserve is trying to engineer a soft landing. We're seeing leading indicators for the job markets weaken, which suggests that the job growth in this country is going to moderate.
Welcome back to Yahoo Finance. I'm Brad Smith in New York alongside Rochelle Akufo at the Capitol. Rochelle, just give us kind of the rundown or at least the playback maybe of some of those conversations you've had there on DC's Capitol Hill.
Sure. Well, the first conversation I had was about the CPI data. Now, it was largely in line with what economists were expecting here, so that cooling at a faster pace here. But then also what that means in terms of the Federal Reserve's next move. The guest I spoke to said still expecting that hike in July, but perhaps a pause after that. So really showing that the road ahead not quite as certain as we see, and that perhaps is why we're seeing some of the major indices trading in this rather narrow range, sort of taking some of this information in. And then I spoke with Senators Gillibrand and Lummis. They're reintroducing their RFAI legislation, which would really set the tone and the blueprint for what happens with digital assets and digital currencies. Now, they laid out that there has been some misinformation that most of these digital assets would have been sort of rumored to be coming under as assets versus securities, but they clarified actually most will come under securities using the Howey test. And they also really talked about regulation improving, more exchanges coming here versus scaring them away. So I thought that was an interesting touch there.
Yeah, some big conversations inside the Beltway there for sure. Rochelle, stick around here as we've got a little bit more to discuss with the time left in the hour. Good news and bad news for Hollywood as Emmy nominations across the wire have started to come through. The chance of an actor strike is becoming a very real possibility in the background. SAG-AFTRA members, they voted to strike if the union can't make a deal with major studios by midnight tonight. Yahoo Finance senior reporter Alexandra Canal is here with the details. Hey, Ali.
Hey, Brad. Yeah, so 11-hour negotiations for SAG-AFTRA, and this time they're with federal mediators. That was at the request of these studios and big-time streaming players who want to try and avoid this double whammy strike after the Writers Guild of America remains on the picket lines for about 2 months at this point. In a statement, SAG said it will not be manipulated by these big-time studios, and it wants to ensure that all of their members receive a fair deal. Now, a big sticking point in these ongoing talks revolves around artificial intelligence. These actors and performers, they're worried that their image and likeness are going to be sold off. And then on the side of the studios, they're worried that they're going to have a game-changing negotiation within this contract that could potentially influence how this type of technology is used, especially since AI is so new in the entertainment and media space in general. Another big sticking point are streaming residuals. That's something that the writers faced as well, how these actors get paid in this new age media. So all of that proving to be a significant headwind. The longer we go on, the more likely it seems that SAG-AFTRA is going to strike. Those actors joining writers, which will be devastating to the LA economy, along with some of our favorite shows and programs. And Brad, like you mentioned, we're just starting to get those Emmy nominations in right now. And it's very likely that that ceremony, which is slated for September 18th, that is going to be postponed due to these ongoing strikes with the WGA, along with that potential strike with SAG-AFTRA. But that being said, we still are receiving these nominations. A couple call-outs for me. Outstanding drama series. This is going to be a very competitive category with series like The Last of Us, Succession, The White Lotus, Yellow Jackets, Better Call Saul, The Crown, just to name a few. I personally love Yellow Jackets, so I'm rooting for them, but I know Succession, that's certainly favored to win. Another category I want to mention is lead actress in a comedy series. Rachel Brosnahan from The Marvelous Mrs. Maisel, that was the last season there. Jenna Ortega Wednesday, and Quinta Brunson from Abbott Elementary. Brad, I know she's a favorite of yours.
She is.
Yeah, and
Philly.
Abbott Elementary, along with Hulu's The Bear, and like I mentioned, Succession, those are the three biggest series to watch, and those are the ones that are expected to sweep. But again, very likely that once September 18th comes around, we're going to see this ceremony be postponed.
And it's tough. I'm a little bit torn because I love Quinta Brunson, but I love Jenna Ortega in Wednesday. I mean, she really absolutely rocked that show. I was not even expecting to like it. I only watched it so I could see if it was, appropriate for my daughter to watch it. And I just sat there and binge watched the whole thing. So good.
I was late. I was late
Succession.
on the Wednesday train, but I agree with you, Rochelle. I ended up really loving it, and she did do a good job. And she's young, so we'll see if she can pull through here.
Look, a lot of people are focused on the bear as well, Ali, and I'm focused on a different bear-y, if you will, because Barry was one of my favorite shows to watch. NoHo Hank, I don't know if he's going to get nominated for anything, Anthony Kerrigan, but absolutely one of the, and I was trading DMs with a former coworker, one of the long-time kind of comedic relief elements that we've needed in television for a long time. So shout out to NoHo Hank, even if there's no nomination there. But Bill Hader did get nominated as well for Barry.
And Beef, which is a limited series from
Beef.
Netflix, that got some love as well. So a lot of different types of shows here in this nomination list for sure.
And in terms of the breakup between the streaming services versus like traditional television, does it seem like the streamers are really dominating this year?
It does, and that's been a consistent theme throughout the past couple of years. Of course, we still have HBO, which is cable, but also has now Max under their belt, has always been one of the top Emmy performers. But from what it looks like right now, we seem to have a wide range of both streamers and traditional media. Obviously, ABC with Abbott Elementary, owned by Disney. That's been a huge win for some of the more traditional network television shows. But I think right now in this current environment, it's all about streaming. That's where these consumers are watching these shows, consuming all of this content. So at the end of the day, I do think that we're going to see streaming giants come out victorious more and more for all of these award shows.
Yeah, and it's interesting to see how some of the licensing purchasing has taken place too. Now that I'm seeing that very woman right there, Issa Rae, now on Netflix.
I know.
Because Insecure and those rights licensed out to Netflix.
And that's just going to become the norm.
Yeah,
we're going to see more consolidation across the board.
Absolutely. We got to go. Yahoo Finance's own Ali Kanau and Rochelle Akufo, who's been down in D.C. holding it down inside the Beltway with some great conversations. Thanks so much. Let's do a final check of the markets here as well with the time that we do have left. The Dow, the S&P 500, and the Nasdaq still holding on to gains. Not as high, though, as they were earlier on in the session. So we've moved off of some of those intraday highs, but still holding on to green across the board. Sector basis, it looks like we are higher across the board for the 11 S&P 500 sectors, led right now by materials and utilities. That's it for now. I'm Brad Smith. You've heard from Rochelle Akufo and Ali Kanau. That's it for Yahoo Finance here today, this morning. You can catch us at 3 p.m.